Alex here. Okay, everybody, hi. Welcome to the second half of what we call, I guess, the International Roadshow. That's what the Trade Guider folks called it. As you know, this is the material that I presented in Malaysia, Singapore, and Australia. And also some of it was presented in Chicago and London earlier in the year. So we're going to finish up tonight, or this afternoon here. It's Sunday on the East Coast of the United States for me, but it's people from all over the world. It's Monday in some places, and certainly different times than 4 o'clock in the afternoon, which is what it is for me. We'll go for about an hour and a half, and then we'll take a 10 or 15 minute break, and then we'll go for another hour and a half, and then we'll do the last bit, which is a bonus, probably take 15 or 20 minutes to go through. So maybe we'll take a quick break after that. So this is going to be a fairly long session, and obviously you won't be able to retain it all, but we have the recordings, and Helen's pretty good about getting the recordings done quickly. So she'll have them done. Her computer is out at the moment, and it should be back online tomorrow, so that we may not get it up until Tuesday, but it should be up by then. All right, I sent everybody the charts. You should have those. We're going to do, doesn't really matter which order we do these in, I guess, but I want to do it this way, I think, using the Weiss wave to focus in on market structure and understand how that can be used in trading. So I'll do a brief introduction to market structure. It's just the basics of it. It's not really the whole enchilada when it comes to market structure, but it's an important part of it. And we'll look at that, and we'll look at how we can detect changes in trend by the application of Weiss's construct of the waves, and how Wyckoff's construct of how the market moves in waves, and also David Weiss's application of that, actually the application of the day trading chart, which Wyckoff used. It was kind of like a point and figure with volume, which is not possible really to do today in today's markets because of the huge amounts of volume that we have. But David figured out that he could do a wave chart and the volume, and it's basically the same thing as a day trading chart, which is quite nice. So we'll look at that, and then I'm going to show you, we're going to go through a week in the Aussie dollar. You'll see down moves, you'll see sideways moves, and you'll see up moves all throughout that week. Downtrend, trading range, and uptrend. And you'll see how we can use the Weiss wave, excuse me, not just to understand the market structure on an intraday basis, but also how we can use it to trade. It's a very useful tool. And what you'll see too is things that we talked about in the last session. We'll look at certain bars as we go through this and look at how to read those bars, and also the 4 trade setups that we saw. You'll see these trade setups repeated over and over and over again. And by the way, this week that I took in the Aussie dollar was, I think, the week before I went to Singapore. I just picked it out and just started working with it, and just looked at it, and it's typical of a week in the Aussie dollar. It's not anything strange here. It wasn't cherry picked or hand picked out to even illustrate this. It just, you can pick almost any week in any market and see these same principles over and over and over again. So market structure, here's sort of kind of the basics, and this comes out of the Stock Market Institute, the Wyckoff Stock Market Institute. It's pretty basic. In there, I think they call it Unit 3 text. yeah, Unit 3 text. And the idea is this, that the market moves back and forth between accumulation and distribution. And accumulation just basically means buying, that people are accumulating or buying in a trading range. And then distribution, of course, means selling, and they are selling and selling short in a trading range. And we'll look at how those play out. Once buying has been sufficient in the for the professional side of the market, if you will, because they're the ones who are buying in an accumulation area, and they're the ones who are selling heavily in a distribution area. So once they have acquired their line of stock, or their line of contracts, if you will, their inventory, then and typically in the traditional Wyckoff method or analysis, the accumulation would occur, and it was designed to sometimes take out, sometimes it would take a few months to do, other times it would take even a few years to do, but it was designed to take out what was called the floating supply, or what is called the floating supply in the market. In other words, the fund or the operator in the market would corner that stock, corner the market in that stock by taking out all the floating supply. What's the floating supply? It's the supply of stock that's more or less actively traded. In other words, there's a lot of stock that's it's locked up in a strong box, or it is collateral. It's in banks as collateral for loans, or for businesses. So when you start taking that, there's a lot that are in retirement funds that don't get touched. When you eliminate all of that, then the rest is the floating supply, and then that's what's generally available, and it's the professional trader's goal to get as much of that floating supply as he or she can. And once that floating supply has been pretty much absorbed out of the market, then the market stands free and clear to be able to be marked up. What they want to do is encourage people to sell down here in the accumulation areas, and they want to encourage them to buy in the distribution areas. Let me say that again. They want to encourage the public who have this floating supply to sell out in the accumulation area, so scare them out, or make the market so dull in a trading range that they give up interest in the stock and they just let it go. And then the operator, if you will, is the composite operator here, is eagerly buying it. And in the distribution area, they have bought all down here, and now they are selling up in here, but they're encouraging the public to be buying because they want to unload into an active market. Okay. OL has a quick question. The Aussie dollar is a futures contract, not Forex. That's correct. I don't trade Forex, but I do trade the currencies, the currency futures. Those are very good instruments to trade. So you will see that the market moves from accumulation to what we call markup, to distribution, and then mark down. And that's the way the market moves. We see that all the time. And here's just another graphic, again from the Wyckoff Stock Market Institute. You can see that here's a trading range with an accumulation area and you can almost see here that we have a selling climax here, scares people out of the market. Then there's a series of tests. There might be a shakeout or a spring here that occurs, a test of that, and then a jump across the creek right? And then a back up to the edge of the creek. And then the markup continues until we get to the point where there's a buying climax. And as the market works its way through the trading range, it's predominantly the public who is holding this up, although the operators are probably involved in it too. But every time the price gets pushed up, the operators are selling out here and selling out. And then probably selling short and selling short. In other words, selling out their holdings that they bought down here, and they're selling out on the climax and all through here. And then as the trading range, the distribution range gets more mature, they're now actively selling short the market. They're taking a net short position. And we will sometimes see an upthrust, a test of that upthrust, a fall through the ice, and then, bumping the head on the ice, and then, of course, the markdown begins from there. So you can see why the 4 fundamental trade setups are so key to the structure of the market, because they really do help you. As I said before, they are both defined by and define the structure of the market. And for any of you who have taken any classes with me in the past, or have seen me trade live in the various times that I do that, you know that I emphasize above all other things market structure. I think it's the most important thing to understand. And when you start to understand it, then the market becomes maybe not easy to trade, but certainly easier to trade and easier to read. And what I mean by market structure is simply the background conditions of the market and how they've been trading. So let's just just going to go through a bunch of charts here just to show you, if you haven't ever looked at this before. Here's Apple on a daily chart. We've got, just kind of get yourself oriented around this idea that we go into a trading range, a little upthrust here, a markdown, trading range, a little spring, jump across the creek, a mark up, trading range, right? Mark down, trading range, mark up. You can see that this happens all the time. Okay, here's the S&Ps, the S&P E-mini on a 9,000 tick chart, roughly about 15 minutes maybe, depending on the time of day. Trading range, fall through the ice, back up to the edge of the ice, mark down, trading range, springs, jumping across the creek, and mark up. Not as aggressive as that Apple stock that we saw in terms of the mark up, or even really the mark down, but still, you can see how the thing works. Here's the S&Ps. I trade that most. That's the biggest. The vast majority of my trades are in the S&Ps, so I'm always attuned to this market. But here we are on a 2-hour chart, 120-minute chart. This is a useful chart, especially if you're not able to generate tick charts. This and a 240-minute chart are very useful. And a 240 is a 4-hour chart. But you can see trading range, accumulation, markup, trading range, distribution, markdown, trading range, accumulation, markup. It's on and on it goes. Here's Goldman Sachs on a weekly basis. One of my favorite charts to help people understand or teach people about structure a little bit. This is the end of 2007, the beginning of the 2008 markdown. If you remember, Goldman Sachs was probably the leading stock, or one of the leaders anyway. Today it's Apple and Google and Amazon, but at that point it was Goldman Sachs, the financials, and it had on a weekly basis an upthrust here. Right, we're in this kind of trading range. We have a little trading range here on the daily. We mark down. We go into another trading range, another upthrust in here, mark down, You can see that distribution occurring just through the idea of market structure. Here's the S&Ps again, this time on a 10-minute chart. And these are different days and time periods and stuff, not all the same. But you've got that sideways movement, that trading range, the mark down, sideways movement, mark up, sideways movement, mark down, sideways movement, mark up. You get the idea? Here we are. This is Caterpillar, a big industrial stock. On a weekly basis, big trading range mark down, big trading range mark up, trading range reaccumulation. We won't really talk about that today, but that certainly can happen. Mark up, trading range mark down, trading range mark up. Even within a bigger trading range, which I think this is probably going to show us, we will see this kind of activity in here. Okay, any questions about that? This idea of market structure. And one way to think about this too is that it's a transfer of stock from weak hands to strong hands. Who's buying down in here? Especially after this kind of a move occurs. It's going to be the larger players in the market because they view, you know, $35, $30, maybe $25. I don't know what the low of this was, but they view this price as pretty inexpensive at that time. And so they would almost be thinking, another way to think about this is that it's not only just a transfer of stock or contracts, but it's also a transfer of risk. In other words, here at this point in time, $80 was too risky. It was too risky to hold this because price was so high. Down here at $30 or $35, whatever this price is, it's too risky not to own this stock or buy this stock because otherwise, you know, you're not going to make money. And so they start to accumulate it in here. And then it gets marked up, and now at 100, 110, this that was bought here is being sold out in here. And, excuse me, and it's too risky to be holding this stock at $100, $110. So that transfer is made. And of course, it's as I said before, they're encouraging buying up here, and you can bet that when a stock hits $100, it's on the financial pages, it's in the news, and people notice that, and they say, oh boy. And they might be saying it's a breakout from the 2008 highs, right? At $100 a share. That's going to get people excited, and they're buying. And notice what happens. Look at that big pullback in here on big volume. That's selling into the buying. And it doesn't happen all overnight. I mean, just take a look at this, how the selling occurs here, and you would think, boy, this is not, you wouldn't expect people to be coming back into the market when it's fallen. But actually, people will think that $70, $80, that's cheap because it was up at 110 just a couple of weeks ago or a month ago. Let's buy it and see if it'll go back up. People do that all the time. It's amazing. When I was working in the hospitals originally, when I just started to get interested in trading the markets, and this was back in 1999 and 2000, and at that time it was the dot-com bubble going on, and I was reading the how bubbles work and how how buying climaxes work, and they would say that people would just be euphoric and everybody would be participating in the stock market. And for any of you who were trading at the time, here in New York City, for example, sometimes you couldn't get a taxi cab, because the cab drivers had their laptops and they were parked where they had Wi-Fi and they were trading. Cab drivers trading, and nurses were trading, and doctors were trading and stuff, so on. And I remember that, there was a big downdraft in I think it was maybe March of 2000 or so, and I walked into a room and there were a bunch of nurses and aides there, medical staff was there, and they were all talking about how they were going to buy. Microsoft was a bargain because it had fallen, I don't know, 20, 30 points, and they all wanted to buy it at that point because they all thought that it was going to continue to go higher. One nurse said, Microsoft, he was a male nurse, a nice guy too, but he said, Microsoft is going to put my kids through college. He was convinced of that. Okay, what is a tick chart? Okay, what is a tick chart? Let's go find one here. Here's a tick chart. It starts, here's the start of a day. Well, let's see. Yeah, here's a day, and another day, and another day, and another day, and another day. Okay. What a tick chart does is that it's not based on time. For example, if you had a 60-minute chart, that would be based on 60-minute time bars, right? And if we go back up here to the 120-minute chart, well, I've got it so compressed here. It's you don't see the sideways movement, the lack of real movement in the overnight markets. But the Asian and even to some degree the European markets are still not as active as the U.S. markets. And for a long while, we just sort of ignored the overnight markets. I'd look at them, and I knew where the Globex, we called it the Globex high and low. I'd certainly look at those because they'd often get tested. But other than that, I didn't pay too much attention to it. And in fact, I would have my data. I wouldn't have the overnight data on my chart. I'd just start from the U.S. Open, and there'd be a little bit of a gap and that sort of thing. But it wasn't all that big of a deal. But as time has gone on, there's more and more trading activity in the what I call the overnight market. But for you, maybe the daytime if you're in Asia or in Australia. It's pretty actively traded now, and so, but still, it's not still. Nevertheless, it still is less actively traded than the U.S. session. So, if you're using a time-based chart, it's still can be fairly hard to read the dull hours of the overnight. For me, that would be from about, 10 o'clock at night, 9 o'clock at night, all the way into maybe 4:30 in the morning. And then it starts to get more active and it's more readable. So as a way around that, what I use, and what I've come to really like, and probably will never shift out of this, is this thing called a tick chart, which is nothing more than a bar. Instead of a bar being made of, being based on minutes, 60 minutes. So rather than being based on time, a bar is based on activity. So this might be 50,000 trades, 50K trades, okay, or 50. And technically, it's 50,000 price changes. That's an activity-based chart, and a price change is called a tick. It's up 3 ticks, it's down a tick, it's back and forth in a range of 3 ticks, that kind of thing. So it's just called, by convention, it's just called a tick chart. So that's what it is. It's based on the number of trades, not the volume, but the number of trades is a way to think about it. Technically, it's the number of price changes that occur. So you could have a 3,000 tick chart. You're going to see on the Aussie dollar, I use a 500 tick chart because it's less active than the S&Ps. And so what that does is it gives us a nice way to compress the overnight data. Okay, So that's tick charts. Let's move on now. What Wyckoff figured out, he said that the most important thing to know about the market is the trend. It is the line of least resistance. Okay? And he thought in terms of waves. Wyckoff did. So in a downtrend, the line of least resistance is going to be, we're going to see that those waves down be larger than the waves that go up, right? The waves down, if it's the line of least resistance, it's going to travel the farthest in terms of price distance, and it's going to spend more time going down than it is going up in a downtrend. Makes sense, right? So in a downtrend, the down waves, that's these here, are going to be bigger than the up waves. Simple concept. Okay, simple concept. In an uptrend, it's just the opposite. The up waves are going to be bigger than the down waves. And we can see that. And we've seen that many times. And it's very, very important to be able to think in terms of waves and to see the market in terms of its wave structure. And when we're in a trading range, the up and down waves are going to be pretty much equal in size. So a down wave is going to be about the same as an up wave. A down wave and an up wave, they're going to be basically about the same size. Okay? Yes, I know that this is a little up wave and a little up wave, and you've got to come to the understanding that, or come to the develop the skill to be able to see through the waves and see what the bigger wave picture looks like. Okay, because that's important too. Quick question here by Chris. Is a tick chart a software function or determined by the way the data comes over? No, it's a software function. You would be able to specify the number of you'd be able to, if your software allows that, then you'd be able to specify a chart based on tick bars, and you'd be able to tell the software how many ticks you want in each of your price bars. So in a downtrend, the market has bigger waves to the downside. In an uptrend, it's the opposite. And when we're in a trading range, they're about equal. So Wyckoff's insight, though, it's a little bit more than just knowing the line of least resistance. And the way we measure the line of least resistance is through the waves. And he said the most important thing to know about the market is the trend. It's the line of least resistance, but he says you must always be on the lookout for a change in this trend. And then he tells you, or tells us how we can detect that change. In an uptrend, when the selling waves begin to increase in time or distance, or the buying waves shorten, either or both will be an indication of a change in the immediate trend. And it's the reverse for a downtrend. Okay, so get the idea here? In an uptrend, and we said that the up waves are going to be bigger in an uptrend than the down waves, okay? Well, when the selling waves or the down waves begin to increase in size or in distance or time, that's an indication that the trend's about to change. Or if we're going up like this and suddenly the up waves begin to get smaller. Okay, that's the idea, and the reverse is true for a downtrend. So, you know, here's a bunch of charts. We'll just go through these quickly, but you can see that, you know, here at A, the up waves are basically about the same size as the down waves, but look at what happens at B. The up waves suddenly begin to increase in size, okay, until we get down here to C, and the down waves start to decrease. And at D, the up waves begin to increase. You see that? See the change? We go from down waves being larger to smaller, to up waves being larger, and down waves now are smaller. Up waves larger, down waves smaller. Okay? And you can begin now, if you start thinking about this, this is the Aussie on a daily basis. And look at this. Suddenly a spring emerges in an uptrend where we certainly are making higher highs here, right? Higher highs and higher lows. That's another way to think about it. And it's a very useful way. It's very basic and very, very straightforward. Very useful way to think about it. And what we can add to that, and we can make it a little more sophisticated by adding the waves here. And then as we pull back, we can measure these waves. And this, by the way, is the Weiss wave here, and I'll talk a little bit more about that in a minute. But just kind of get the idea that the waves here are smaller. And now, suddenly, when springs appear, and we have up waves larger than the down waves, well, that starts to make more sense for us to be able to take a trade, right? So the up waves are bigger at D, and then suddenly they shorten up at E, and then we start to head down again, okay? And at F, I just drew this in, the up waves are starting to get larger again, potentially. You can begin to see that fairly quickly. Here's Apple. This is just before it did that last little push up to 705, which would have been up in here. And look at this. And then we all know what happened in Apple, right? This was last September, 3 months ago, 2 months ago. Up waves are really strong here at A. Then they start to shorten up at B. They get a little bit larger here. Then at D, they start to increase again. At C, the down waves get larger. Then at D, the up waves start to increase. And we're moving up. And I noticed this, and I said to people at that point, I said, boy, Apple may be coming to the end of this leg up, and we may see a pretty good, we may see a pullback. And there it was. I mean, it was all detectable. Here we are, the euro currency, on a weekly basis now, okay? Up wave was pretty good, but then they start to get shortened in here, and the down waves at B start to increase. Then we get larger up waves coming in. Doesn't mean that it's going to turn right around and go down to up. There can be, a process may have to take place, but we see the change that the up waves have gotten bigger than they were over here, or even in here. And even, no, not quite there. And they're good for a while, and then we see the up waves get smaller up here, and then the down waves pick up. And on it goes. Study these charts. I won't go through every little nook and cranny here, or every wiggle and waggle. Just take a look at these charts when you have a moment and see that here's a weekly chart, a daily chart, another daily. Did I not put up a intraday? Well, it's the same thing. You're going to see the Aussie dollar in the wave structure anyway with this. What is time and distance here? I don't really think about time so much, Eric. I'm just looking at the size of the waves rather than the distance. I think the time, I'm sorry, I look at the size or the distance of the waves. The distance, for example, on this chart, the distance would be from here to here. That would be, let's call that wave 1. This would be to here, wave 2. Right? 3 and 4 in here. Notice how the down wave got smaller on this little pullback in here. And then it starts to move up. And then, so this would be 5 and on. Okay, so that's the distance. In other words, the amount of movement in price. I don't really focus on time too much. You can do that if you want to. David plays with that. David Weiss looks at that. I don't bother doing that because it's just, I don't think it's really needed. Okay, any questions on that? This idea of the waves being an important component of understanding the market structure here. Are my waves drawn on closing price or mid-bar, or is it just a visual representation? They're drawn on the close. They're not drawn on the high or the low, the Weiss wave. Let me talk a little bit about the Weiss wave. Let's do that. what you see on the chart here is the Weiss wave. And what it does is it measures the waves, and you can set this in the software. You can set, like for example on the S&Ps, I set it on the intraday time. I might have it for 1 point, or often use 3/4 of a point as the wave size. So in other words, the Weiss wave will not paint a new wave until there has been at least a 1 point move. If I was using a 1 point move close to close in the price bar. Okay, and you can set that to anything you want. Once it does that, it continues until there's a 1 point move to the downside, and then it starts a new wave down. All right. And so for the S&Ps, for example, I use 3/4 of a point for the intraday. The higher time frames, I might use 3 points, 5 points, and 10 points. Those are the standard ones I use in the S&Ps. The Aussie dollar, I think I use 0.0001 on the slightly higher time frame, and 0.0005 for the smaller time frame. So that's how the wave paints. And the software allows you to do it low to high if you want to. We've never found it that useful. We just do it close to close. It's good enough. What the Weiss wave also does is it tracks the volume on the wave. So this is just the volume of this wave here. Okay? And this wave here, we'll call this X, wave X. That's the volume here. Just adds it up. Okay. What settings would I recommend for stocks? It depends, I guess, on the price of the stocks, but you can use, for higher time frame like weekly, you could use a 3 point, and for intraday trading, you could use a 10 cents or 20 cents. 10 cents, I think, is good. 0.1. Play with it. See what looks good for you. See what looks good for you. There's no there's nothing written in stone about this. So, for example, now we can look at this and we can say, well, we got a nice, I didn't label these, but let's call this, I'll just do this with numbers. Let's call this wave 1 up here, right? We have a nice move up, good volume comes in. But suddenly on waves 2 and 3, these up waves, right? These number 2 and 3, look at this. The volume drops way off, okay? The volume drops way off. And then suddenly on D, we get a big down wave and the volume picks up to the downside. And it comes in here too, right? A little bit less. Look at on this last wave. That's this volume here. Very little, okay? It's saying that the market's having a little bit of a difficulty going down. And if we look at this, we have a spring set up in here, right? Seeing this kind of a thing, where there's low volume on this last wave, that's pretty nice. And you can be kind of aggressive and you can say, okay, we haven't started to turn up yet, but I can see that there's not much volume as we come down through here. So I can take a long trade. But you want to wait anyway until it's closing back up above here. Then look at what happens here. Up to this point. Look at this wave. Volume comes in. We haven't seen this high volume since up here, since over here. Back in a year ago. Right? So suddenly volume's coming in off the bottom. And look at this nice test of the spring. And look at the low volume on that test. And in fact, the last little wave down, minuscule volume. And we rally up again. Bang. We get good volume coming in. Demand is overcoming supply here. We pull back, very light volume. Then we push up, lots of volume here, but suddenly the market dies. And then we start pulling down in larger waves and the volume starts to come in a little bit bigger here. Okay. We'll see that a lot as we go forward. So it is a let's see, is that typical of what a test looks like? Yes, very typical. We'll see some of these in the Aussie dollar here. So the Weiss wave is useful in so many different ways, and I'm going to talk mostly about structure and context here, kind of as an introduction to it. But on an intraday chart, if you look, if you take a 5-minute chart, say, of any market that you trade, and you look at it intraday, most of the time the volume comes in high in the morning and then high in the afternoon towards the end, and in the middle it does this kind of thing. It's what we call the smile or the U of volume, the intraday trading volume. It can be very hard to read that volume intraday. Certainly not impossible. We did it for years. But using the Weiss wave, as you're going to see now in the Aussie dollar on an intraday basis, it really kind of makes the volume jump out at you, and it really is incredibly easy to read. Well, I shouldn't say incredibly easy to read, but it really makes the learning of the Wyckoff principles and reading the market through the Wyckoff lens, it makes it a lot easier. Let me say it that way. Okay. Now, as we go through this, for the day traders out here, I'll give you a lot of things to think about in day trading, but swing traders can also benefit from this, and we're going to do something more. We're going to do something for you guys at the end here in the second part of this session today. But the same ideas hold here. You'll notice that I'm very interested in yesterday's high and low and the 2-day high and low, whatever is, for example, here on this chart, we're going to look at this day's trading. This is the most current day here. And the days end with, you can see that they're marked here. And that's the exchange when they end the trading day. So here's day 1, day 2, and day 3, the current day. So if we think about this is the current day, then this is yesterday, and then this is 2 days ago. Okay, 2 days ago. So what I'm interested in is yesterday's high, which is here. Somewhat yesterday's low, but I'm really interested in that 2-day low because it's lower than yesterday's low, right? And here's the 2-day high, but I'm not really interested in that because yesterday's high is higher. So what I'm concerned about is what's the trading going to be like around yesterday's high, yesterday's low if we didn't have, I'd be interested in yesterday's low if we didn't have trading a little bit lower that was still that was a swing low here. This market had gone up like this and came down and made that low. So I'm interested in the 2-day low and yesterday's high. Okay. And for swing traders, you want to be aware of last week's low and last week's high, or the monthly low and the monthly high, depending on your time horizon. Okay. And if you're a big position trader, holding things for years or 6 months to a year or more, 2 years, 3 years, 4 years, you want to be aware of quarterly and weekly highs and lows and where they line up. Okay. So what I'm going to show you here is basically how I trade on the intraday, and then later how I would trade on a swing basis, applying the Wyckoff method. And there'll be a lot of nice little pieces here to be able to see. But here's the naked chart, just price bars here. And now when I put on the Weiss wave and a few trend lines, you begin to see how I start to frame out the market in terms of its structure and how I use the Weiss wave to help me detail that structure or fill in that structure. Okay? All right. So you should benefit from this, hopefully. If you notice here, we're in this trading range the 2 days ago here, this day, right in here. You can see that there was not a lot of activity, right? The volume was relatively compressed compared to the other days that we have on the chart. And you would see that, because you'd have days over here, and you would see what the volume was like, and you can see that it's not all that much. Notice on yesterday, we rally up on this wave here, wave 1, and we pick up in volume, we break through, and then we immediately come back down again. Okay, so more volume than we saw yesterday on any up wave, and we break up above, and we go up above, and we don't hold that high. That we break up above yesterday's high. Here's yesterday's high here. Okay, I didn't mark it, but there's yesterday's high. We break up above that on pretty decent volume, but we can't hold it. So that says that there was an effort to rally through this high, yesterday's high. And that effort is measured in volume. There's a lot of good effort in here, a lot of volume in here, but the result was pretty poor. The result was it got sold off. Okay? So here we have an up thrust. And we can see that as soon as the market starts to dip underneath here, it's a very good trade. And we would know that at the time because there was good effort to go up and it didn't hold. Okay? There was good effort to go up and it couldn't hold up there. And so instead it up thrust. So that's a nice, you'll see that later on when we talk about the trade that I took when I was in Australia, one of the trades I took when I was in Australia, and using this same principle of effort versus result. Effort is the volume, result is price. It's a key Wyckoff principle, right? Effort versus result. And that effort equals volume, result equals price. Lots of volume here. Price didn't go anywhere. It fails. That has to be supply. That has to be selling coming into the buying. There's certainly buying there, but selling is coming in force, pushing this market down. And notice what happens. We get a bigger down wave than we've seen before, right? We break up. It's a fall through the ice. Right? Then we bump our head on the ice and then we come down. Notice the down waves in red are larger all the way down than the up waves here. And we're really looking at this day's trading in here, the last day. And you can see not only is it bigger waves, but the downside volume, until we get to here, is bigger than the upside volume. All right? We're going to detail some of this out in a minute because I want to show you also how to begin to use multiple time frames in your trading. So we fall through the ice, we have an up thrust, we fall through the ice again here. You see that? Big wave down, little wave up, perfect short, perfect short. So now let's look at this. Okay, here's a couple of questions. Let's see. Given that there was an increase in volume on the up wave to take out yesterday's high, would you take the short on the failure below yesterday's high, or given the increase in volume, would you want to see that tested? No, I'd take it right on. If this fails, it's going to fail. I wouldn't wait for it to be tested. And in fact, it really doesn't get tested, at least on this time frame. So I'd be, I'd notice that immediately and say that that's just supply, a heavy amount of supply when I see that. All right, so here's the same day here. Here's the same chart as above. Let's go back up. You can see this is the 1500 tick chart in the Aussie dollar currency future. And that is the same chart here, right here. It's the same chart, 1500 tick chart. Alongside of it, I've put the 500 tick chart. Okay, and if you're going to use multiple time frames, you want to have a minimum of 3 times, 3 to 5 times. So you could use a 500 tick chart and a 1500. That's a nice combination for the Aussie dollar. I use in the S&Ps, my smallest time frame is 3,000. I'll just use 3K. And then I look at 9,000 and 27,000 tick charts. Okay. I look also at 5,000 here on the Aussie, and I think I look at 10,000 too, if I'm not mistaken, 10K. So you want to have enough space so that there's enough vibration between the time frames for yourself to be able to make it meaningful. All right. Is looking at waves more useful on intraday swings than long term? No, it's certainly useful on the intraday, but it's extremely useful on the longer term as well. I just showed you, I think it was a weekly chart on Apple, or maybe it was a daily, I forget which, but we looked at several years worth of, go back to your chart and your charts that I sent you, you can look at it later, but just look at the Apple chart. It's on a much higher time frame, and I think there was a weekly chart of, I forget now, the euro currency maybe. I forget exactly what charts there were, but there were different time frames. I didn't have any, in fact, on that, when we were talking about structure, I really didn't have any intraday because I have all these intraday charts here with the Aussie dollar. Okay. All right. So, look, you've got a fall through the ice on big volume here on the wave down to 3. Okay. You see that on your higher time frame. So you'd be looking on your shorter time frame, and you'd be looking for an opportunity to go short. Well, 1 or 2 opportunities come up here at B, right? Look at the low volume to the upside here. The green volumes up here would be the little waves going up. There's just no ability to rally the market up. Okay? Pretty good. So then we start coming down and we make this wave down on this volume. That's good. But what happens? At C, here we have 2 other waves coming down, and look at the volume to the downside diminishes. And in between that, we get a pretty good upside volume for this little kind of small time frame. So that tells you that this is going to try to rally up again. And in fact, we get a small, I'm going to erase this here. We get right here, we have a small spring on this last dip down. So if you're short here, which is not a bad play at all, if you're short here, it's a good play because it's a fall through the ice. So if you're short here, you have a decision to make. The market says it wants to rally up a little bit higher. We don't know how high it's going to rally. Is it going to push up and go maybe up into this area here where they test this supply in here? Maybe you wouldn't want to hold on there. Or maybe you feel like there's not really that much volume coming in. What difference does it make? I'll just hold, and you've got your stop set up in here somewhere, and you say to yourself, I'm just gonna hold it. So that's a decision point. But seeing this, you know the market is about to try another little rally, and so you might want to scratch out of your trade, exit out for a small profit. I do that all the time. All the time. There's no shame in scratching out. Just because you put a trade on doesn't mean that you have to have it work out. That's kind of silly, really. I probably scratch out of, I don't know, on a given week, probably 7 or 8 scratched trades maybe, or scratches, sometimes more. That's just a guess. I don't even really know because I don't track them. But I scratch out of a lot of them. So anyway, so you might scratch or you might hold. That's a decision you need to make. So we rally up here, and that's on this volume here. We have a little pullback, and then we try to rally again, and what happens? We have an up thrust on very small volume. Look at the volume at 4. Okay? And so we can also consult our a little bit higher time frame, and we see that it's a little bit of a pickup in volume, but certainly 3 looks like supply has swamped demand, and so it's unlikely that this is going to rally up very much. Okay, so here's a nice choice point trade as well, a great place to make a trade. Whatever demand was holding up the market here is now gone because it had an opportunity to go up higher and it didn't. And I don't know if you can see this or not, but there's a little test of the up thrust on that bar there. I'll just put up thrust test in here. And you may not be able to see it, but it's there. And there's another one, not really a test, but another opportunity here and so on. All right. So let's go a little further in this. We come down on our higher time frame down to 5. Volume picks up over the last up wave. The down waves are larger than the up wave, right? So what are we looking for? We're looking for, we've just fallen through the ice again, if we consider this to be a little trading range in here, which it was. Now we've fallen through the ice again, so we're looking to bump our head on the bottom of the ice, which is the low level here. And we'll look to make a trade there. And so we can go to our smaller time frame chart. We might have gotten excited about this and shorted here at D. That's okay because very light volume coming up. Right? We might have taken a trade there. We get some volume to the downside, but then we hold and we start to go sideways here. And we come back up, and this is actually the better spot to make the trade. But either one is fine. You know, no one's perfect in this business. In fact, I think I did trade this market this week, and I did take D here. I think I took the short at D, and I had my stop, I think, probably up above this level, right up above here. So I just sat through this and let it all occur because I was looking for another wave down, another leg down. If we get this and a pullback, we're going to get another leg down. That's the theory of that, okay? And that's what we got. Notice all that volume coming in at 6. It's the biggest upside volume of the day, right? It's happening in the morning of the U.S. session, but that's a lot of volume coming in, and there's been no reward. It's very similar to what we were looking at over here, isn't it? Where we had the big volume come in and the rally up, but then it fails. Well, here we have big volume come in to the upside, and it goes nowhere. It goes absolutely nowhere. So that, again, is effort versus result. Good spot to make a trade right in here. Okay. Okay, a couple of questions here. Is looking at waves more useful? No, I answered that already. What is the main benefit you have found for tick versus time charts? More, because I can read the overnight market. This is occurring right in here. This is 5 o'clock in the afternoon to 8:30 in the morning. I guarantee you, I cannot read, well, I can, but it's very hard to read this overnight action with in a 5-minute chart. It's almost impossible to really read it. So, because it would be strung out, long rows of data, long price bars with no volume, and you just can't tell what it's doing. Okay, so compressing the data down, that's what I mean by compressing it, down to a point where I can read it. Okay? All right, now, we see here, so now from 6, we're looking for that leg down and we get it, but it helps to know where we might want to exit a trade too. So we want to construct a diagonal trend line here. We've got a down move occurring here, right? And so we can place a trend line to the downside off of 4 and 5, take a parallel of that, put it on this, which would be 5 here. I didn't mark it, but that would be 5. Okay? And we can see here at 7, we are oversold in the trend channel. Okay? We're oversold here. And we have a little rally up, and then at E, we come back down, come back into that same area, and look at the volume. Smaller wave down when the down waves shorten, and distance or time. And what David says, and I think this is true, and I don't really want to go into the details of this, but I think, but it is true, and it's useful to understand. And that is that Wyckoff saw time as volume. He really measured volume, the amount of volume being traded as a good surrogate or a good indicator for time. Okay, so we're not spending much time to the downside here compared to this down wave or this down wave, right? And we can see that in the volume. It's a good measure of time, volume. Volume traded is activity. And this is a measure of activity over time. So here we're seeing no further supply. And it's almost a test of this maybe small selling climax in here. And if we hadn't gotten out at 7, we certainly want to get out as the market starts to turn back up. And we want to get out at E, or right around E, because it's telling us that now there's no more supply down there. If there's no more supply, then the market is likely to rally. Okay. Tong says at D, let me erase here. At D, I might not short because there's a potential spring. Sure, except that we have just broken down below this big trading range here. Okay? We've just broken down below a 2-day trading range. And if we've done that, Tong, very unlikely that we're going to spring. Very unlikely that we're going to spring here. Okay? So just something to keep in mind. And that's understanding the larger structure. Why do I say that? Because remember I said distribution area, people would sell in here, the larger interest would sell, and they did. And now they want to mark it down and cover someplace lower. They don't want to cover, they don't want to do all this work in here to just get this kind of move out of it. They're looking for something bigger. Okay? It's another way to think about it. But a good comment, good question. Is there an example of a chart in both time tick over the same overall period? Not on, Chris, you'll have to do that one for yourself. I'll put that one back on you. You can study it and see how they interrelate or not, or what one tells you that the other one doesn't. But I don't have those charts, and I don't have the software up at the moment, and I don't want to be constructing charts in the middle of a presentation. It's not easy to exit at E until the market turns up. That's right. That's right, Eric. But remember, we are on here. This is on a 0.0005. Okay, close to close. So on this bar here, this first bar after the low of E, you would know that the market is now turning up, and you would know what that volume is. So it doesn't bring you out right at the bottom tick, but it does close enough for our work, for sure. I mean, that's good enough. That's good enough. And look, you're reading this price bar in here. That's climactic action. And look at the price bars over here. Look at how you've got buying coming in on this bar and buying coming in on this bar. This is E, this second bar here. That's E, right? That's the E bar. As it comes down, it's 2 bars here for E. So if this is 1,500 ticks, there are 6 bars here. And if you count these, 1, 2, 3, 4, 5, 6. E is out right in here. So you've got time to, you'd see it. You would definitely see it. But you need to train yourself and you need to practice it a little bit to be able to see that kind of a thing. Okay. Good, Tom. Glad you got that. Spring does not work well in a downtrend, says Ivan. That's absolutely right. In relation to Tom's question about the potential spring, it was the same with the S&Ps this week. When we broke below the monthly low at around 1394, there were several attempts to spring that failed miserably. Yes, Brian, that's right, they did. And that is the absolute worst place to take a spring, is on the breakdown of a good trading range. So if you remember on the spring chart, on the spring and up thrust and fall through on the 4 trade setup segment, I went through at the end. I put up 2 charts. They were both tick charts. One was of the S&Ps and the other was of the Aussie dollar, and they were just springs and up thrusts on them. And I said, if you did nothing but trade springs or up thrusts, you could make a living at that, as David Weiss always says, and he's absolutely right. And on that chart, I put I numbered them, S1, S2, spring 1, spring 2, spring 4, that sort of thing. And there was one, and I forget which chart it was. It might have been the S&Ps, or maybe it was the Aussie. I forget which it was, but there was an SX. If you go back and look and you remember what we said, that we were just breaking down from a large trading range, and that is the absolute worst place to look for a spring. Bar none. That is the worst possible place to look for a spring. And that's what we have here. Okay, so let's see. I think I got the questions. All right. Okay, so here's the end of this day. Here's 7, and then here's E, and then the rally up after E. Let's put some structure onto this. And so we're going to look at this next day here, a big wide swinging trading range day, which is, let's go back here for a second, not surprising after 2 days of steady downtrend. It's not surprising to get these wide swings like this. Why? Because the market is trying to digest the last move that was just made. And so they're looking for, fair price in here. They're looking for a reasonable price. So buyers will take it up and sellers will sell it down, and you start going back and forth and back and forth. And you start to notice here, if we apply David's Weiss wave on this chart, it's the same thing as before. Here's the Weiss wave applied. We can see that the waves are equal here. Also notice is that the waves start to get narrow. They start to get smaller the farther we get into the trading range. Okay, it's a useful thing to know. So here we come down. This was 7 on the old chart, and also kept that 2-day low from yesterday, which is the 3-day low. We kept that. I'd be aware of that, and this is yesterday's. Well, this technically is yesterday's high here. We can draw that line across. Yesterday's high. So you could have that line on your chart, but I'd be most interested in that 3-day low still. So what happens? Look at the light volume in here on the move back down. This is one of the ways that the tick chart is so valuable and the Weiss wave is so valuable compared to a regular time-based chart. And if we can see that wave coming down here on the smaller time frame, the 500 tick chart, shows a little bit more volume relative. But look at the big volume that came in here on yesterday on that rally up, and we did in fact break through that downtrend channel that we had in here, where we looked at this at 7 being oversold. So we've now broken up above the downtrend channel. That's important. It means that buyers were able, before, the up waves were small. The up wave here, the up wave here, but now suddenly the up waves have gotten bigger, and not only have they gotten bigger, they've been able to break the downtrend line, the downtrend channel. That's important. So now we come back and test. We get a pretty good sized down wave, but it's not the same as the previous down waves, is it? It's not as large, and you can see that pretty nicely on the higher time frame. That's this wave here that we're talking about to 1. It's smaller than this and this. And the up waves have gotten larger. The up wave has gotten larger, the down wave has gotten smaller. Either or both are an indication of a change in trend. And that's what we're seeing here. And we get a nice zip up here, a good rally up. Look at the good volume that comes in. Okay? And we can track that. If we look at this on the smaller time frame, we might have a trade here at these 2 points here, these 2 A points, where we can see that good volume comes into the upside, and each time we come down, we get small volume in here, right? Good volume, good movement, good wave, and good volume to the upside. We pull back, we get shortening of the thrust in here, we get a reversal bar, and we have small volume. Those are locations for an intraday trade, okay? Those are nice locations for an intraday trade. And you can see on this chart that we're just pushing up. We don't want to go any lower. We don't know where we're going to go to the high, but we're not going lower. That's the key thing. Okay? That's the key thing. So let me erase this so it's clearer. We place trend channels now, this time to the upside from here and here. And we can see that we get overbought in that trend channel at 2. And look at, suddenly the volume starts to get smaller here. Waves haven't gotten smaller really. They're pretty good size. But the volume is now making this wave suspect. Is this a place that we just go ahead and short? Well, you could, I suppose, but I'd wait a little bit for more confirmation, more of an indication. And we get that at B. What happens at B? We get an increase in downside volume. For this whole day, we don't see any volume like this. This is the first time we see a good sized down wave. And if you look at these waves, this is the size of this wave. Compare that to this wave, and this wave, and this wave. This is the biggest down wave with the biggest down volume since the uptrend began. It's what we call a change of behavior. Why is it a change of behavior? Because each time we pulled back, we made a smaller wave and light volume. Smaller wave, light volume. Smaller wave, light volume. For the first time, that's been our behavioral pattern here. Now suddenly we get a bigger wave down on much bigger volume. Behavior has changed. That's an indication that supply is overcoming demand. So look at what we have here. We have at the 3-day low, where we know it stopped the market yesterday, right? In the morning, right over here, it stopped that market. That was important there. We're back to that same area. Suddenly, buyers have lost interest in the market. Sellers have gotten interested in the market, and we're seeing lack of demand on the up wave and a sign of weakness, change of behavior on the down wave. So we wait here and we get this push up to 3, and we consult our higher time frame, very little volumes coming in there. We have more volume coming in here, but it's still not as large as the waves up, and we get an up thrust. and that up thrust has a nice response to it. Okay. Okay, question from Fiona's here. Hello, Fiona. Good to see you. On a 15-minute and 1-hour currency chart, do you have a suggestion to set the Weiss wave to? Just play with it a little bit. I would try maybe 0001. Try that on both, on a 15-minute and on an hourly, and see what you get. I think you'd find that to be pretty good. That'd be 0.0001. Try that and see if that works. Okay, so let's go ahead a little bit. Again, we want to use the same way we use trend channels going up. Now we can use them coming down. We have an up thrust at D. Look at the light volume there. Right? We have a bigger wave coming down to C on big volume coming down. So the change of behavior that we saw at D, up thrust at 3, now has a good result. We see good effort coming down on C, high volume, and we have a good result because the down wave is now larger. And that runs from this point to about this point. Okay? Then we get an up thrust at D. We're looking now for short opportunities, right? And we start to get oversold in the trend channel at E, and we're not getting all that much volume there. So it might be a spot where we think about taking the trade off. It happens to go a little bit lower down to F, but again, we don't get much volume, and the market tries to rally up, and then it comes down here at G. It's kind of probably hard to see this, but there is just no volume there. None whatsoever, and we are all the way down at the bottom edge of the trend channel. So if we hadn't gotten out of shorts at that point, it's the same as we saw over here at E. It's the same concept, isn't it? This would be 7, which is here, and this would be E. You see these things, they come in different flavors. They you know, it's a little bit different look, but it's the same principles operating, and this is a test of that, and it's telling us if we haven't gotten out yet because of that volume, we better get out now. Or we're subject to getting whipsawed, and wham, look at what happens. We get that market moves. The bar at D, how would I enter? Just as it's coming down through, would look to enter that trade there, just as it's coming down through here, because this is pretty weak in here. The wave B could be holding gains. No, I don't. Holding gains would be going sideways. We'd be going sideways here. We pull back. This is the biggest down wave that we saw on the up wave here on this time frame. So I wouldn't think it would be holding gains. And we're not pushing up through a known resistance level, really. I mean, we haven't seen a lot of accumulation down here. It wouldn't make sense for it to try to hold gains in here at this point. We're just coming off of 2 days of downside momentum. So the odds favor further downside. We just want to wait for the market to get exhausted to the upside. So we would then look at at 6 we see a test over here. We haven't talked about this as a really trade setup. Some of you might have that in your repertoire, but you can see that the up wave now has clearly gotten larger, and we've gotten the biggest upside volume here on 5, and the down waves get smaller and the volume dries up. So here would be an opportunity to take a trade in here. You'd like to have it spring, but that doesn't give you that option in here. There are other things going on in the chart. If you extended this line out, you can see that we have traded. We're going to talk about this a little bit later in the next segment. There's been a lot of trading around this 1.03 level, or 1.0, whatever this is, 1.029. there's been a lot of trading around this, and that would give you a little more confidence to be able to go in here. But we rally up to 7 and we get an up thrust here, and we certainly get good volume coming in, but we are at resistance. We have a trend line, a trend channel here. We're having difficulty getting up there, and we get that up thrust. You could take a trade here if you wanted to, but you might have done so well during all of this, you said, the heck with it, I'm not going to do any more trading today. Well, that's possible. So we kind of get into this, into a little bit of a, we kind of, from yesterday's low to that 3-day high in here, we test the low, test the high, test the low, test the high, come right back into the middle of the trading range, or near the middle of the trading range. Very typical for a day after a trend day, a good solid trend day down, or a couple of days down. But as we said before, the momentum is still to the downside. And this, I guess, must have been Labor Day. And I put this in. There wasn't much trading. As you can see, the volume is pretty light here. But again, the 2-day low now, this is where we had that, where 7 and E were back here. So now it's 2 days ago, so we call it the 2-day low. And I'd be having the 2-day high in here as well, or yesterday's high, but it's not on this chart because we don't need it. We fall down through this ice, and at 2 we come back up. Look at the light volume, and bump our head, but we never really get much momentum to the downside, do we? And I think it's mainly because this is just a really small day in the market. I think this is just a half a day, September 3rd. My guess is this is Labor Day, which is a big holiday here in the US. But again, if you were trading this around here at 2 and it does a little up thrust, if we drew a line here, we have an up thrust here, but you can just take this trade when you see this kind of wave down and then this kind of wave up, and we get on this little small up wave here at 2, we get no volume coming in. And then we come down and look at 3 here. There was effort to go down. We see that in the volume. No real result. Not that we would take a trade here. I think this was a holiday, but just to see it, even on a holiday, you can see this kind of stuff. Okay. And so, yeah, there we go. We rally up. I forgot what this looked like, but here's again, yesterday's. We look at the higher time frame first. We've got yesterday's low. This is where we saw the effort to go down right here on the smaller time frame without much result. Now we get a spring, and it takes us back up to the ice level. And you can see pretty clearly that, again, down here to 1 on the smaller time frame, a lot of effort to go down, not much result. We spring it. There's a test of the spring, a nice test of the spring, and it rallies back up to here. And then it just kind of goes sideways for the rest of the day. I don't even think I looked at that all that much. No, didn't really look at that all that much. Okay. So let me just pause here. Is this helpful? Are you guys getting stuff out of this? Okay, good, good. All right, just want to make sure that this is useful to people and you get something out of it. All right, so we'll go another day, and this is typical in the markets, right? We get kind of crummy days here. Sometimes they're not that great. Again, we look at yesterday's low, yesterday's high, but yesterday's high is not really relevant. We break down, we come back up, we bump our head. We get good volume now this time, and very light volume coming in here. So we have a good opportunity to make a trade here. But typically this downside momentum is drying up, and we can see that. But I'm just going day to day to kind of, I mean, you'd want to be looking at the daily chart as well with this and a higher time frame than the 1500. But I just wanted to go through day to day with this to show you how you can make trading decisions based off of the Weiss wave and based off of the 4 basic trades that we talked about the other day. And you can see that, you know, over a few days you get some nice trades consistently over and over again. So here we are with the 500 tick and the 1500 tick charts. We break down. The down waves are bigger than the up waves. You can clearly see that here, the down wave and the up wave. When we rally up, we even do, here's a little shortening of the thrust. We up thrust it as well. I mean, all of this, you know, here's a bump against the ice and an up thrust with shortening of the thrust. You know, what else do you really want, right? And then you can draw in your trend lines here where I drew from this high to here. This is another reason why the tick charts are very useful. If you try to draw trend lines on a regular time-based chart and you're trading these 24-hour markets, you're going to drive yourself crazy because they're not going to be accurate. Because there's too much space in between. The tick charts make them much more accurate and much better for you. And I'm talking about diagonal charts. I'm not talking about the diagonal lines, not the horizontal lines. And that's important because diagonal lines are difficult because they're going to change on you all the time. And sometimes you're going to make a trading decision based off of them, and it's going to change, and you're going to say, boy, why did I do that? But that's, you know, that's the nature of trading. So we can draw a larger trend channel in here, and you can see that down in this area we're getting oversold in that trend channel, and volume is not picking up on the downside here. And also we can draw another trend channel in here. And once again, we're getting oversold. And then we can see that we're holding in here and springing off of this level. And that's an aggressive trade for people to take. It's, you know, it's your decision. If you've got to stop yourself somewhere down below here. So you might not want to put too many contracts on if you see this. But you've got oversold, lack of supply, and a spring setup. It's not so, it's, you know, that's an aggressive trade, but a good trade nevertheless. And again, we want to use trend lines to help us. We get good response off of that spring and we break the downtrend line, this downtrend line here. We certainly broke it here. Yeah, let me go back to this for a second and just give you a little clue about why this would be okay to take. I should have extended this downtrend line, and if I did, it's pretty poorly drawn, but right in here we're going to take a spring, and if this spring goes, it's going to almost immediately break this downtrend line. I like that. When I can do that, then I know that that spring has a good chance, even though we're in a downtrend here. If I'm close to this line and I've got a spring, and if it's not a lot of distance to take out that line, then I know we've got a good shot at the spring. It's just something that I've gained with experience, that if we can break that downtrend channel off of a spring pretty quickly, then the odds are good that it's going to be a good spring, a successful spring. Okay, that's just a little piece of information there, a little tidbit that's useful. So when I see a situation like that, and I'm not too far away from breaking the downtrend channel, then I think it's a good trade. It usually works out pretty well. So we get a good response off of that spring. We increase the size of the up waves. Now the up waves are bigger than the down waves, and the up wave volume is coming in to the upside. Down wave is smaller, downside volume. Now as we push up and we get overbought in the trend channel, look what happens. The up waves start to get smaller here at B and then certainly at C. And look at the volume just diminish, right? And we're back up nearby yesterday's low again. So any spring that was taken, we want to get out of here. We want to get out of that trade. No real trade to take down here, but or at C, unless you want to trade a no demand at the overbought level, which is okay to do, but that's not in my playbook. It's not one that I would take. I would notice it, but we don't really get a change of behavior here until 5. And then we do. We get the down wave is increasing, downside volume is increasing. Okay? Then we start to get a little pullback. We're looking for an opportunity to go short. And we can, again, even on this little small segment here, we can put in a trend channel, see that we're overbought at E. Volume is diminishing to the upside. We get that up thrust at F. There's our trade. And we take that. We don't get a lot out of it. We get some movement down, and the waves get larger. The downside volume gets bigger. But then look what happens. We kind of, at G, we get this little spring and there's no volume left. So once that happens, we want to get out of that trade. And we'd be out of that somewhere in here. We wouldn't want to overstay. Because it's just, suddenly this market's kind of drying up. And also there's shortening of the thrust at 3. Shortening of the thrust at 3. At 3? Murat, I'm not sure what. Yeah, there's some short. Oh, I see what you're saying. Back here, yeah, there is. I didn't see that come in before. You're right. There was some shortening of the thrust for reasons for the spring. Good observation. If we were to look, Murat makes a very good point. Let's do that little graphic. I think I showed you. Maybe I didn't. But if you look at this here, that's here, and this is here roughly. And this is here. So you can see that we made a good drive down, that's to here, and then a pretty good drive down, that's to here, but now suddenly we're not making much of a drive down. So that's also a way to measure shortening of the thrust in the waves themselves. Okay? All right, so now we have the market has gone for 2 days having trouble going down, and it held not making lower lows yesterday and just going into a trading range and getting fairly narrow range. We didn't get much good trading in here, and we can see that there was an opportunity to rally. Okay, so let's play this one out. Again, we put in yesterday's low and yesterday's high in here. Look at how nicely the waves change for us, and we get this up wave larger. Look at the big volume coming in. Okay, we kind of got a little hint of that yesterday in the trading range, that the upside volume started to come in. We come down here at 1 and test and then push, and what's this? This is a jump across the creek. We saw falling through the ice lots of times. Now it's a jump, and then as we'll see on the shorter time frame, we've got a spring in here on the backup. Very nice. Okay, so let's take a look at this in the smaller time frame. In effect, we also have a spring here too. So you can see that. I didn't mark that here, but you can see the nice response to that. So we rally up to A. We get pretty good volume here at B, but we're holding gains. This is where we're holding gains now because we're trying to push through a daily high. This would not be a bad spot to take a trade. Perfectly fine. You wouldn't be so happy in here, I suppose, and you might have scratched this out or just taken a small win. But that happens sometimes. Sometimes we think it's going to go much higher and it doesn't, and we might exit out. But we can draw a trend channel in here, and we can see that on the dips down here, which is this one, and then where we've got 3, you can see that they're fairly light volume, and then we get larger volume with this again is that effort to go down, no real result, and we have a spring on top of yesterday's high. Oh my goodness, do I like that? that I'll take any time. There was a little test of that spring here, and it immediately gave good volume to the response. And the test of the spring is this volume here. Very, very light volume test. We break out and push up. And again, we can draw in a trend channel here. We can see that we get, a little push up, and then volume is slight on the pullback. The waves are smaller. Waves are bigger going up. Pullback to E is smaller. The volume and the waves going up are very strong. And then we get overbought in this trend channel, right? And then look at what happens. At F, we have a little change in behavior, don't we? Bigger up wave, bigger down wave, and bigger volume. And that causes the market to start to roll over here. We push up, look at all the volume coming in here at G, and there's no result. This is a lot of effort to go up. We should see, another leg up like this on all that volume, but we don't get that. Instead, we're rolling over. Okay? So shorts need to be exited out of that. And that was partly because it was the end of the day. So we come back now, and they're taking profits at the end of the day. So now here's yesterday's high. We ended here. We kind of rolled over. As we said, this was probably 4 was in here. And this was the end of the day. You can see we push up, and we get these kinds of movements up. And on the higher time frame, the upside volume, hands down, is bigger than any downside volume over here. So that's telling you to hang on to your trade if you got in, if you had a good entry and you got in early in the day. This is a trend day to the upside now. We saw those coming down. Now we've got one going up, and it's good volume coming in. So here's yesterday's high. We push up, and then we come back and test, and look at how when we come back down and test, look at, we draw out no supply. If this was going to go down, we would anticipate that the market would pick up volume on the downside after pushing up and then coming down, because this is an upthrust of yesterday's high, but it's occurring in an uptrend. So you have to be cautious about this. And when I see this kind of thing, that would tell me immediately it's okay to buy this and look for a push up above yesterday's high. That's an aggressive play, but it's there nevertheless. Look at the response that we get on the push up. The waves lengthen again, right? And look at all the way up. We get light volume. I just mark those as A. Little down waves, little volume on the down wave. Okay? Then we come to this point 2, which is over here. You can certainly see that there's good upside volume. This didn't even pull back enough on this time frame, but on this time frame it's smaller, it's finer, so we're going to see those pullbacks, and that's okay. That's why I like to use a couple of different time frames at the same time, so that I keep myself oriented properly and not get excited about little wiggles and waggles in the market. Here at 3, what do we have? We have a spring on a down wave with a good effort to go down and no result, period. And on the higher time frame, there's really not a lot of volume coming in. In fact, it's less than the last day of the last wave of the day yesterday. So we see that effort versus result. We have a spring in an uptrend. We've just broken up above yesterday's high. There's no, well, I shouldn't say there's no way, but the odds are very good that that spring will continue, and it does. And it pushes up. At wave 1, you've got volume, but price doesn't go up much. Which wave 1? Which one is that? Maybe back here on this other chart. On wave 1. Every wave 1 for the last 3 days has been a down wave. So I'm not sure, Ying, what you mean by that. Tell me which one again. Oh, okay. That's all right. No worries. Will we enter at test bar before 3 on 9-6? 9-6. 9-6. At test bar before 3. I've got to go back, I guess. Am I not catching up? Am I missing these questions here? 9-6 is here. The test bar before 3. No, we wouldn't enter a test bar before 3. We would enter on the spring. We'd enter on this close right here. That's where we would enter. No test bars. No test bars. We'd enter on the spring. You understand that? I mean, there's a lot of stuff going on here. It's springing this level right here. This is the low. This is the spring. That's the bar on the close that we take right there. More conservative traders can take this test in here of the spring. Okay. Yeah, I'm going to break in a few minutes. I just want to finish up this here because we're almost done with this section. So I got lost here. Okay, so spring, we rally up, pull back to 5, look at the light volume, and another spring. Spring in an uptrend. Beautiful. We can place a trend channel in here, and we can see that at 6, we're not making it all the way up to the top of the trend channel. At 7, we have another change of behavior. Down wave increases, certainly the downside volume increases, and it tells us we don't want to, we might buy this spring, but I wouldn't bother. I'd be looking, maybe not for a short trade, but I just wouldn't be trading this market now, because now it's going to go into a trading range potentially, and really what happens is we just start to arch over, we get shortening of the thrust. But that change of behavior kills the upwave. Uptrend, as it always does. Okay, let me just do a little quick summary here. Structure, as I hopefully am pointing out to you, is vital. And the way we identify structure, the way we frame it out, is just with classic trend lines, the use when we're intraday trading of the daily highs and lows and the 2-day, 3-day highs and lows, if they're relevant, and the waves. Okay, we can certainly see by the waves when we're in a trend and when we want to stay with those trades that we're in a trend. And we also know when the change of trend occurs. I've talked about changes of behavior, shortening of the thrust. 2 key things in changes of behavior. When the up waves, if we're in an uptrend, start to get smaller, or the down waves start to get bigger. It's all the same stuff, just talked about in different ways. And we're using the Weiss wave for this, which is a great, great, great tool. You can see how the interplay of the waves and the volume really work well. And then the classic trade setups. That's pretty much all we talked about here, maybe with 1 or 2 tests or something. But you know, that's the basic, the fundamentals of trading the Wyckoff method. And that's, you know, that's what it is. That's what it's all about. And so we wait for a new low, and we look for that spring. That's right. Okay, so I'm going to stop here, and I think I covered all the questions. If I didn't, yeah, I did. I can see I covered them all. So let's take a, let's see what time it is. It is 47. Let's come back at, do you guys want 20 minutes, like 6:05? Shall we do that? Is that going to be enough time? 10 minutes, people are saying. Which would you prefer, 10 or 15 minutes? Either 6 o'clock or 6:05. Yeah, 15. Okay, so we'll come back at 6:05. I'll see you in 15 minutes then. And resume. Okay, so here we go with the second half of the second session. We're going to just look at this now on a swing trading basis, and we'll talk about the same principles, the same setups. Again, we're going to do a currency. This is the British pound. And we're going to look at these principles over 4 months of they're intraday charts, but I forget, I think they're 180-minute charts, so they're 3-hour charts, or maybe it's 240, I forget which, but it's a good swing trading chart if you're going to be trading this market on the swing. And we'll look at the key elements of turns in the markets. We'll also look at a little bit of continuation plays. That's something we haven't really talked about. Clearly the use of trend lines, bar by bar stuff, and the waves. I won't have the waves on the chart this time. In terms of the Weiss wave, we're going to look at price bars and volume more so than anything else. And this is the British pound, the Great British Pound. And it's just, we'll use structure here, we'll just deconstruct it, if you will. And one of the things that we talk about when we're looking at a market is we look at the waves clearly, and we'll look at those as well. But when a market's making a lower low and a lower high and a lower low, it's in a downtrend, right? We can frame that downtrend out with the use of trend lines, which we've talked about quite a bit already tonight. And we're going to continue to talk about them because they're extremely useful. And again, just, when we're in a downtrend, we're going to draw our downtrend line from a swing high and a swing high, the next swing high. And they're going to be the two significant swing highs, right? We might, and then we draw a parallel off of the intervening swing low, okay? Now we might have a trend line that goes like this, and we draw it off, so we draw it off of this point, and we would put it off of the intervening swing low, which would be here, okay? We might have that kind of a trend line. We might even start, if we were drawing this, we might do this and put the parallel off of this swing low. But then as it moved outside of that and then started down again, we would have to adjust our trend line and do this, okay? And at some point we would say, okay, wait a minute, we see that this is a bigger wave here, a bigger wave down and a wave up, so we'll draw them off here. So we're always going to be adjusting the diagonal trend line, and that's okay. That's part of the nature of trading and part of the nature of using a trend line. The more touch points a trend line has, the more valid it is. And this one has a touch point here and a touch point here. Okay, those are touch points. All right. Now we can see that the market isn't coming all the way down to our trend line here, is it? So we can draw what we call a reverse use of trend line in here, if you like. It's just, we in a downtrend we start with the upper trend line, and so a reverse is just using the lows here to draw it. It's nothing. Doesn't, it sounds great, but sounds sophisticated, but it's really not. Also notice too that we're seeing volume basically diminish on the way down. Okay, just gradually. I'm not going to do the Weiss wave volume here. That would be useful for us, but what I want to do is take us back a little bit to just more classic chart reading and looking at price bars and volume. This is a 180-minute chart, a standard chart, no tick charts or anything like that. Okay, you can do it this way too. There's nothing wrong with doing it this way. And we can see that we came down on 1 here, and we had some pretty good volume come in. So maybe the downtrend's going to resume. but we would note the low here, and look at what happens when we dip underneath at 2. We get low volume, and we get a spring down here as well. Is this something I would take? Possibly, because we've got, this is, when we use a trend line like this, or this dotted line, it's also indicating that we've got a shortening of the thrust in here, potentially occurring, if this holds in here. So this might be an aggressive trade to make, okay? Might be an aggressive trade to make, even though we are in a downtrend. And the main reason for that is because we are seeing a little bit of shortening of the thrust in the waves. And what I mean by that is if we drew the waves in like this, and assuming this one stops here, then we've got some shortening of the thrust occurring, right? Or if we do that little thing that I did before, we get to this point, roughly to here, and then suddenly we're down around here, okay? So potentially the down waves are shortening here. And we're not making it all the way down to the bottom of the trend channel. We're not even making it now down to this trend line, are we? And we have light volume here. So there's enough reasons to make a trade. There's enough of a story there to try to make a trade. And here's the waves in here. You can see that the down waves potentially are starting to shorten. So taking a trade here is okay. It would be an aggressive trade, but it's not a bad trade nevertheless. Is there a preference to using volume bars over the Weiss wave, or are they interchangeable? Well, Craig, there are different ways of looking at the market, and I'm showing you a couple of different ways. It kind of depends on you. I do both. I look at both all the time. It doesn't mean that I have a 5-minute chart of price bars and volume up on the intraday. I use the Weiss wave for that. And I'll use the Weiss wave on a daily, but I certainly look at the daily bars and the daily volume. It's a combination of both. I'm just looking at it through different lenses when I put the wave volume and the waves on, okay? That's all. And sometimes it helps and gives a slightly different perspective. So potentially good trade here. Let's see what happens to this. So when I do this chart, I'm not going to have every little detail on it all the way through. I'll just have the last few pieces on here. So what do we see here? What happens at 3? Isn't this the biggest up bar that we have on the largest upside volume in this whole move down? Okay? Biggest up bar on the biggest upside volume in the whole move down. It's the change of behavior again. It's the same thing, just a slightly different look. It's the change of behavior. Now what we're looking for this market to do is to break this downtrend line. That's what has to happen next. Okay? And you can see that we're going sideways. Here we're holding gains because we have supply in here, and we've got this as a target to get through, and we are not seeing any downside volume come in. It's fairly light volume. So we would anticipate that this market would drive through. Okay? And I'm going to go a few bars at a time here, kind of walking us forward. We're going to go through 4 months worth of trading here, starting in December, and we're going to go through into March on this chart. And so we push through, okay? And we do so, and that's good, but look at what happens with the volume. We're not in keeping with this level of volume here, are we? No. And as we come down, we don't really draw out any more volume, but what happens? We get an up thrust here. And volume comes in, and we close it poorly, okay? We close it poorly. And if we've been in a downtrend, and look, we started this, what is this? This is back in early December. of this, whatever year this was, 12.4. And we're down here at the end of December. So if we've been coming down for a whole month, this market isn't going to turn on a dime like this. It's not going to turn and just go straight up. It's going to do some backing and filling, probably come back down and retest some of this area down here. Okay? Excuse me. So here we have a short opportunity. Now, we're trading off of a 180-minute chart. That's our basic chart here. We could do exactly what we did with the Aussie dollar, where we were using a 1500 and a 500 tick chart. Here we're using a 3-hour chart, so we could go down to a 15-minute chart or a half an hour chart, something like that, and base our trade off of that. Okay, but we won't do. I'm not going to do that here. It's not part of this. But certainly you can do that, and you saw the techniques used, and they are the same techniques, same method here as we would be using, as we used on the Aussie dollar, as we discussed that with multiple time frames. Now, notice that we have broken decisively above this downtrend line. And we had shortening of the thrust in here. And we had a change of behavior. Right? Break the line. The trend line break. Trend line break, I guess. Okay? Now, certainly we've got an up thrust. And certainly the odds favor that we're going to go down because we've been in a large downtrend, but we have all this strength in the background. So we are not looking for a new leg down. When I say a new leg down, I mean a new leg underneath this low here. Maybe a retest of that. That would be the target for this trade, okay? But because we have shortening of the thrust, change of behavior, break of the trend line, we are not looking for a big home run here. We're just looking for a small trade. Okay, everybody understand that? That's important. People lose sight of what their targets are, what the market is going to be able to give them when they go into trades like this, thinking that, oh, I'm going to get a whole new leg down. Probably not going to happen. So what happens in the next little segment here, we drop down a little bit and we're going sideways. So what happens here? Is this positive or is this negative? Well, let's look a little closer at this. As we see here, this bar 6 coming down brings out volume, and it's a down bar. Right? Now, when we see a big spike up in volume, typically the market will pause for a little bit. Sometimes it'll change direction. But this is supply coming into the market. And then we go sideways. And as we try to rally up on this, well, even the bar after 6, no success. 3 bars after 6, no success. The next bar, no success. And then what I labeled bar 7, no success. And bar 7 is a small up thrust, right? We call this a hidden up thrust because it's a little difficult to see on this time frame. But if you went to a smaller time frame, you would see that, let's say we went down to that 30-minute or even a 15-minute chart, there would be a high here that the 15 or 30-minute chart comes back up to revisits and then up thrusts. So we call this a hidden up thrust or an up thrust on a smaller time frame. It really doesn't matter what you call it, just as long as you understand what the what the market's doing at this point. And this is a nice location for a trade. It's an up thrust. on a smaller time frame. Okay? And again, you can drop down to that smaller time frame or not. You can still read it here. And so we would anticipate that this market would fall a little bit further. And it does. Okay? Now, what's it doing here? If you look, we have this big drive up here from this small little spring. And the odds are that we're testing the supply in here because there was good volume. And the question is there any more? We've been in a big down move. Is there any more supply left? And so they're coming in here and testing. But look at this. This is rather difficult to figure out. We've got up bars here. I've labeled those as 8, right? And the last one is on the high volume here. Yet we have a lot of down. Every time the market tries to go up, it's having difficulty. Okay? When it goes down, it pops up. But when it goes up, it bounces back down. It falls back down again. Because we're moving down and we have lower high and lower low, the odds favor this will continue to go down a little bit more, maybe to test the lows down here. We don't know. We'll have to see. Okay? I'm sorry, Terry, I didn't see the thing there. Can this be an absorption period of supply to the left on 1219? Supply to the left, 1219 would be in here, I guess. Are you talking about this or are you talking about this? If you're talking about this, yes, that's probably some absorption here. If you are talking about this, no. That's too wide of swings. When you see absorption, you're seeing a very narrow range. You're holding gains in there very well. This is not holding gains. We're chopping up and down in here. Okay, good. Glad you understand that. Good. So let's go a little bit further. And what happens down here? We do go down lower, right? But we're not making lots of big progress down, are we? Let's frame this a little bit with the downtrend line. As I said, we were making lower highs and lower lows, so we can put a trend channel on here, okay? And we can put a horizontal along this level, and we can notice that we have it's kind of hard to show this one. We've got this move here, and then we're not making much progress. And better, I think I've got waves on this. Let me just see. Yes. Better to think about waves here. We've got a nice up wave, and then we come down pretty good, but now the down wave is starting to get smaller. That's that shortening of the thrust again in here. Okay? That's that shortening of the thrust. Let me go backwards here a little bit. One stop. And remember I said that when we have a spring situation like this and we're very close to breaking the downtrend line, that's generally a good situation, okay? Even though we're in a bit of a downtrend. That's generally a good situation. And that's what we're seeing here. And in fact, when we dip down here, we see that volume pretty much dried up. Even actually these last 3 bars here are pushing down, and we're not seeing any volume coming into the downside. And then we start to move through. So you can buy this spring here, or you can buy it here, or I guess the bar before this. Let me erase this so you can see it a little bit better. The proper place is here. It's also buyable here and buyable here. Any of those 3. And because we're close up against this downtrend line, the odds favor that we're going to break that downtrend. And of course we have the waves in here, as we said before, and there we go. We break the downtrend line very nicely. Okay? So framing this out a little bit more, we push up through this high, this swing high. So now not only did we break the downtrend line, we have a spring, we've broken the downtrend line, and now we've made a higher high here, right? Because this was the last high, and this was a low, and now we've made a higher high here compared to the last one. And at 13, we make a higher high again. And now we come back and look at the volume has dried up to the downside as we've come back. We are on top of that previous high here, and that's support. All right? We frequently see this where previous resistance turns into support. Okay? But there's much, much more going on here. Much, much more in terms of, this is a new concept for many of you, in terms of trend lines here. If we look and extend this out, we can see that this market has been trading around this level, whatever this is. I kind of alluded to it a little bit on the Aussie dollar chart on one of the days that we had been trading around a given level for quite a bit of time. We call this an access line. It's as if the market is rotating around an axis. And it's this level here. So you can see that as the market was coming down at this point, this was finding support. I have those green arrows up to show that there was some support at this level. And it rallies through it, or tries to rally through it, and then comes down. So it's also acting as resistance here. And it falls underneath, it comes back up to it, more resistance. Then we have that spring and the end of the change of behavior. We hold at that support level here. We rally up, we come down, we test it, we up thrust. Here was that up thrust. Here was that hidden up thrust, and it's still acting as some support. We go down through it, and now it's acting as resistance as we try to push up. This is where that number 9 was, those bars that had number 9, and then this was the 8 here. It's trying to push up above this level, but it's having trouble. Okay? And we come down, and here's that spring at 10. Now we finally break through it, and we break through it decisively by 13. And now we're back at 14. Now we're at 14. We're back at this same level again, light volume after decisively breaking through. What do you think? Is this thing going to hold then? Sure. The odds favor that it will hold. Okay. Once you break through an axis line and you come back to it and test it, that's what they're doing, testing to see if there's any more supply here. And notice at 12, it rallied through and then came right back down underneath, pushed up, and then held on it right in here. It's a very important level. And look at all the volume that came in, on both of these bars, going up and down on both of these bars. A lot of activity in there, and that's why not surprising because of this. There's been activity all through here. A lot of trading going on through here. And now we're back at this level, and the odds favor that because we've now found no supply, where just a few bars ago, over here, at that same area, we found quite a bit of supply. And so the odds are good that the market will push up. And so that's an ideal spot to take a trade, because we have broken the downtrend, a spring, shortening of the thrust, a good drive up on good volume, broke through the axis line, and now we've come back to test it. That's a great spot to take a trade, right in there. And this bar here, by the way, erase the lines, this particular bar, this very last bar on the chart, dips underneath the low of the previous bar, goes under, finds no supply, and then rallies up and closes fairly firm. We call this a test, or you can call it a hidden test. I don't know. Tom Williams has different names for it, but The other way to think about the other term for this is a key reversal bar. Key, K-E-Y, reversal bar, because it dips down and finds no support and then rallies up. You'll see them all the time. I mean, these are key reversals, but they don't produce for us. Key reversal here, dips underneath and rallies up. Even here, there's a little bit of a key reversal bar. Okay. And one here. And they're test bars. They're just test bars. That's all they are. Key reversals. Very good spots to take trades. So we rally up, and we rally off of that nicely, that axis line. And we put in a higher high up here. Now, we'd be coordinating this with a higher time frame chart, but we can see, we don't have that here, but we can see that if we drew in a diagonal trend line, we're coming right to that diagonal level here, and we have previous highs in here which were resistance before, now act as support over here, just like we saw when we were talking about 14 to begin with. We said, well, this was a swing high coming down, and that high was resistance, and it will act as support. And then we expanded this out to talk more about the axis line, but don't forget about that. This was a swing high here, and we were working on support. And you can see that the waves are certainly bigger to the upside. Okay? We do have some shortening of the thrust in here. It's kind of hard to move this market up. We do pull back quite a bit. We do break underneath, but we've got a spring on top of what's old resistance, new should now turn into support. That's a good trade in there. It's a very good trade. And so we can see that it climbs up here. But what's happening up in here? Two things that I see that immediately alert me to difficulty, immediate difficulty in the near term. One is certainly the low volume. We're not increasing volume on the drive up. That's not bullish. That means that they're not following price up. The other thing is that we're not coming all the way up to the top of the trend line, are we? The trend channel. This is another form. This is shortening of the thrust occurring in here again. And we can draw that diagonal trend line in, and we can see that at this point we're making less progress to the upside. Again, if we did that little graphic from the low here, we've got, say, this high in here. We've got this high roughly here. And now we have this high, which is here, or maybe up here a little bit, maybe a little bit higher up. But you can see we made all this progress, and we made this progress, and now we're at the top, a mature trend, right? We've been going on in this trend for a while, for several days here, and we're not making much progress, and the volume has gotten lighter in here. So my stop on this, I'd be jamming it right up underneath here, probably right on these lows, right on that low. Okay, on whatever, if I still have a trade from here, or if I for some reason got out and I'm in a trade from here, or if I held here and I added here, my stop is jammed tight to this because I don't want to lose anything if this market starts coming underneath. Okay? And so what happens? We go a little bit higher, not much, and we come down and look at the volume coming in. We don't really quite have the biggest downside wave here. You can see that it's basically about the same size as the last one and even the last one. But we've got that change of behavior because every time this has come down before, the volume's dried up, and this time we've got bigger volume coming in. Not a good sign for this market. And again, you can see that the up waves are starting to shorten up here. And we did that little graphic that kind of explains it maybe even a little bit better, but you can see that this wave is not the same size as these two. It's gotten smaller. So we're alert to that, okay? And what happens? Would I trade in here? No, I'm just alert to it. So what happens? Clearly a change in behavior now, right? Look at the downside wave here coming in. We could see it up here. And in fact, we could see that there was trouble in here by looking at the waves and looking at the shortening of the thrust and the lack of volume. And then if we hadn't gotten out of our trade up in here, we certainly would be out somewhere in here on all this volume coming in and this ease of movement down. Okay? But now clearly we've got a good solid wave to the downside. Big downside wave here. So let's see what happens with this. But we're also, if we construct a downtrend line in here, a downtrend channel off of the highs, here and here. We might start here, but we might do something like this, but we've got to adjust it. Okay, and we make that adjustment if we do, and we can see that we're oversold in the trend channel. Now I didn't put this in, but you can certainly see that if we drew this line here, we have fallen through the ice. If we drop down to a smaller time frame, we've fallen through the ice, and we have opportunities here and here for trades to make on a smaller time frame. Maybe if we went down to a 30-minute or a 15-minute chart, okay? And we did all of that, lots of that with the Aussie dollar. So I'm not going to repeat it here, but you can. One of the skills that you want to develop, one of the things that we were doing in deep practice on Thursday night, was looking at monthly charts and identifying what was going on the daily from the monthly or on the weekly from the monthly. You can do the same thing here. You can look at this, and this is a 3-hour chart, and you can draw this trend line across, and you can say, what's happening here? Well, this is on a 15-minute chart, this is a nice upthrust. 15 or a 30-minute chart, right? There we have an upthrust. And you can see it's helpful to be able to see into the market, into the time frame when you're looking at larger time frames. Okay? So we've rallied up, and we've also broken that downtrend channel. So not necessarily a great spot to take a trade in here. However, clearly the down waves have increased in size. So we look and we see that we've now developed into a trading range over the next week or so. And we come down, we sprung. That could have been a trade, especially on an intraday basis if you were trading it. You might trade it on a swing too, because we have broken this downtrend line. You might make a quick swing trade here, just trade on the turn. You have to be really nimble with this and fairly close to the market if you're doing this on a swing basis. But we can see now a trading range has developed in here. Well, let's take a look at this in a little bit in some detail. As we come down to 19, we see volume pick up, and we also see the spreads increase. As we go up here, we do get a little volume, but it comes in kind of at the top, and then it dies out up here, doesn't it? So that volume in here is probably more selling. And also, it's easier moving the market down. Look at this big down move here to 20 than it is to move the market up in here, isn't it? And we come to 21, and there's no volume to the upside. And we have an upthrust, right? Now, if you look into the market, if you read into this time frame, not only do you have an upthrust, but here on a 15 or a 30-minute chart, you've got a test of that upthrust. So either bar here on this 180-minute chart is a good spot to take a trade. Okay, good spot to take a trade. And again, if we expand our horizon a little bit, we can see that here we had that previous swing high that we came to, and we also know that there was a swing high back over here that served as resistance. It's not shown on this chart, but we again see this kind of axis line in here. And notice that we've been on this time around this axis, we were above the axis line here, and now we've come below it. And we're at it again, and we're unable to rally, and we have an upthrust situation at that point. Prior, when we were looking at this, I guess we didn't have a spring, did we? But we were looking at this as a test of this on low volume. It's kind of the same thing in reverse. Now we're at low volume here. So for a lot of different reasons, we've got a short opportunity to take. And following this market out, the response to that upthrust is very good. It's very strong on that volume. We do kind of go sideways in here, but we get another upthrust in here, and that pushes the market down, and we've fallen through the ice down here. And we've also, this is where we were looking at that spring, we've also made a new swing low. Okay. Any questions on this so far? And let me ask it this way. Is this helpful to do this as we go through, you know, not quite bar by bar, but section by section, and apply all the waves and everything to it? Okay, good. Good. Yeah, you're starting to get the hang of it. Good, Fiona. That's good. That's important. This does take practice, and this does take practice, and it does take some effort to learn. You know, I said that in the very beginning, especially looking at it bar by bar. You've got a lot of things going on. You're trying to piece it all together. Take your time. Go through charts. The last time, in the first half of this, I explained to you a little bit about how to practice this by taking long periods of charts, and then looking at the time frames that you trade on them. Well, this is what we're doing here. It's basically the same thing. This is how you would practice this and look for these things. As I said before, you can't just listen to this presentation and expect to be able to go out and trade it. It's just not possible to do, unless you're, you've got like you're a genius and you've got a photographic memory and can immediately integrate this kind of stuff. A super high IQ maybe. Maybe you could do it just with one listening, but even then, I bet you couldn't. It'd be hard to do. Okay. Yeah, there's no questions, so it's helpful. Good. Are the axis lines more of a feature of Forex? No. They're in every market, in every time frame, all the time. You'll always see axis lines. They're all around you. And you have to look for them because they're not obvious when you look at a chart naked. That's why I showed you on the Aussie dollar chart, I showed you just the naked chart to begin with, and then showed you the chart for when you put structure on it. And that's why structure is so important. Those trend lines and all that sort of stuff is so important because it helps you frame out the structure. You have to do that in order to trade well. At least the way I trade. You have to do that. It's not about indicators, and it's not about... And I use on one or two of these charts, I think there was the 310 oscillator. I use that. It's a helpful indicator. It's useful, but it's never enough. And it's always the last thing I look at. The structure is always the first. That's always what I'm trying to understand most, is what is the structure doing? What's the market telling me by its own structure? Okay. Could you also show us where you would take trade entries and exits periodically as examples? Yeah. This is absolutely. I thought I was trying to do that. I said I'd jam the stop up here by taking this trade and taking, actually not here, but here, this trade. Okay. And if we were still holding on from somewhere in here on this trade here. So there were three examples of trades there, and then this was the exit. Okay, here, if we were short from this, then the exit was here as we got oversold. Okay, in the trend channel. If you remember, this came down and it got oversold in here. That's the exit. You know, if I traded this on the spring, which I wouldn't, I don't think, the exit, I'd be looking for it to exit here. And it, you know, if I saw this, I'd be out, period. I would just be out. You know, if I see this kind of shortening of the thrust and then a big price bar down, bang, I'm gone. Here, I'd probably look at this and say, okay, I want to be out on this bar here, the short from here, this up thrust here. I'd be out on this. I'd be looking at this and thinking we're pretty oversold, so I'd be out in here somewhere because we're also coming down to support. And now I'm expecting a rally off of support. Okay, but overall this is a negative market. If we look, oh yeah, good point. I forgot about this. You draw the trend line in here, and we are oversold in this larger trend channel. So yeah, we'd be out. And notice how earlier we had this trend channel in here, right? And now we have a new low here, so we would put a new trend channel in. We're constantly changing the trend channels. And it can be very vexing for novices because they, you know, are seeing trend channels everywhere and never seeing the right ones. And it takes some time to figure this out and take some experience to know where the trend channels should be drawn and how they should be constructed. So in looking at this, the other thing that I'm noticing is that the down waves are much bigger than the up waves. Okay, and I think I probably have that chart in here. But I'm expecting a rally because we're oversold. But overall, this is negative. And so what I would be looking for is the market to do what? To come back up into here, to bump its head against the ice. And I'd extend this down a little bit, and it might, you know, it might come up into here, but I'd be looking for a trade here. This is my first spot to be looking, trying to anticipate. Where is that market going to go to? And my anticipation is it's going to be in here. Okay. So let's see what happens here. Well, we rally up and we get this reversal in here, this top reversal. This is a Tom Williams idea where the market goes up and then comes back down again. Now, looking deep into the time frames here, on a 15-minute chart, we would have an up thrust in here, wouldn't we? We'd make this high, we came down, so we would see that we had made the high and we come down, and now we've come back up against it and we've up thrusted it. Okay, that's just these two bars in here. I'd also note that if I constructed trend lines in here, I'm overbought in the trend channel. Okay, and also light volume at the top of the rally. And what else? We're bumping our head against ice. Okay, we're bumping our head against ice. So there's another great trade. And look at, we've got down waves are still bigger than up waves, even at this point. So there's my trade in there. Okay. Then we come down to and make nice progress coming down. We would construct another trend channel. I'm oversold in the trend channel. I've got light volume. I've got a small spring. We're close up against the trend line. This would be an aggressive trade. One I probably wouldn't make because we're in a good, I'd be looking more for another opportunity to go short. But if you were a really aggressive trader, this wouldn't be terribly bad to try for. But look at what happens. We just go sideways. We don't really get any kind of lift off from that spring. So here's something to note. When we get pretty good response here on this spring, we come back and we test it. That's good, so we're positive here. But then look what happens. We chop around. And this market could have easily fallen back down here. If I had seen that, I'd scratch out of that spring trade if I had taken it here. But really, it's because of the big down move that we're in. This is not likely to change the market. I'd be looking for a trade probably up into, I got a little ahead of myself there, probably up into somewhere between this low here, which it did get to, and this low here. Be looking to, and seeing this kind of bar here or this kind of bar, an up thrust, I'd be out of there. But anyway, let's go back with this. So we come up, we are again at the ice level, or this isn't really quite ice because we didn't do a large trading range, but where we had resistance, we're now coming back up to support, and we're getting an up thrust in here again, right in here. It's kind of going back and forth, tries to hold initially, but this is negative. Dipping down like that on high volume, then it turns around and closes on its low. And again, the down waves are still dominant here. We have more time here. This is one of the reasons why I don't pay too much attention to time in the waves, although Wyckoff did. There's a lot of time here, but we're just going sideways. We're not really making any net up progress. Yeah, no ease of movement up. Right, there's no ease of movement up. And so what happens? We start to slide down again, and we come down. And look at where we are here. Right here, where are we? Think about this. Now we're dropping down through the ice, and now we're backing our head back up against the ice. We can draw a small little uptrend channel. You see the same stuff over and over and over again. This is the way the market works. And we rally up, we kind of hold in here, we push up, and look at the volume. There's just not that much volume there. So there's where you want to, there's a trade to be made. Again, the wave structure shows that the downside is greater than the upside here. And look at what happens. We come right out of that, and we come down, and now we're down into this area here. What, if anything, does this look like to people? What might that look like? Climactic, yeah, selling climax. That's right. We get that. We've been in a mature trend for months now, 3.5 months since the top of January, 4 months. And now suddenly we get this accelerating move down on wide spreads and very large volume. And look at the close on this. That's most likely a selling climax. And what we can do with that, however, is we can construct a trend channel, and we see that we got way oversold in the trend channel. So that's not a surprise to see a selling climax occur there. So any trades taken here, nice little up thrust here, right? Can you see that on the smaller time frame? Then it dips down and kind of tests it there. Any trades taken here or here or here must be exited on this. Okay? Must be exited here. Now, sometimes the market will just come up and roll over and go down a little bit further, but there's too much buying in here. There's too much buying in here. A couple of questions. Is it easier to see the springs and the up thrust on the tick charts rather than time charts? No, not really. The tick charts, for me, here's the thing. They're very helpful in using them to see the structure in the what I call the overnight market, which is the European and Asian sessions of the 24-hour markets. The tick charts help because the volume still isn't there to give us the good volatility and the good structure. So they're very helpful to do that. Now, if you're day trading on any of these sessions and you use tick charts, you don't want to be jumping back and forth between tick and time-based charts for the same time frame. So in other words, you don't want to be going on the S&Ps a 3,000 tick chart and looking also at the 5-minute tick chart, 5-minute time chart. You can do that if you want to, just to kind of see what the volume is doing on a bar by bar basis. You can consult that from time to time. But I found it's really not even worth doing that after a while. You don't really even have to do that. That the tick charts are good enough as they are. And I don't mean it good enough as if they're second rate. They're perfectly fine. They're perfectly fine. So any other comments or questions on that? But yeah, that would be the place to exit out. So we've gone through 4 months here, and let me just give you some comments about this. All we're doing here, we're just applying this to one market in one time frame, just looking at trend lines, and we introduced the idea of axis lines, which are really potent pieces of information that few people understand. In fact, few people in the world understand the Weiss wave, and few people understand axis lines, and few people really understand Wyckoff, although more and more people are coming into it. I've been using the Weiss wave since David first showed me that in 2006, and I'll bet there weren't more than 4 or 5 of us using that up until recently when he decided to make it public. He asked me, he said he would show it to me, but never show it to anybody else, and I never did. I never did. One time I had it on my charts, and I was teaching a course, and somebody saw it, and I had it on there by mistake. I think I was showing a live chart, and that popped up, and somebody said, "What is that?" And I said, "Well, I can't tell you about that. It's something that I use, but the person who created it asked me not to even show it, and I felt bad that I even showed it, that I even revealed it that way." So that had been kept close to the vest for quite some time, and now David is writing. He just sent his book into the publisher, and it's in his book, and he's been wanting to let it out and let people know about it more and more. So now we show it to people, and it's a very useful thing. And you don't really need to hold things back like that. I don't think it's part of the Wyckoff method, and it's a very useful tool. But that was his choice, and that was his right to do that because he created it. So we didn't show it. But you've now been introduced to it if you haven't seen it before. So you're one of probably less than 300 or 400 people, if even that, probably 200 people who understand it a little bit and can use it, and you can learn more about it. I put a lot of stuff up on my blog. I show it, show examples of it, and you can practice with it. Deep practice, we use it as well, so you can learn more about it. But you've gotten some pretty good indications of it tonight in just this hour and a half's presentation on the Weiss wave. And I'll show you a little bit more, some more sophisticated uses of it in a moment. Oh, don't you start. No. Sorry about that. That thing is programmed to come on. I usually don't do anything on Sunday evenings. So anyway, you've got that. So the and the axis lines and the trend lines, especially the horizontal ones. I mean, those are key. You could see the falling through the ice and the jumping across the creek. We didn't have too many jumps across the creek today, but the falling through the ice in the British pound and the Aussie dollar, we had jumping across the creek. I mean, those horizontal trend lines are just gold in my judgment. They just are, and they're good because you've got a fixed point, right? And they're not going to change. Unlike the diagonal trend lines that are going to change, the horizontal ones, once they're there, they're on your chart. So that makes them better too, in my judgment. Let's see if questions come in. Can you explain some of the theory behind the Weiss wave as far as I am assuming it switches between red and green volume based on price level? Not really. I'll show you. I'll come back to that question when we do the trade that I did, this little bonus thing. I'll come back to that question, and I'll explain exactly how it's used. In fact, maybe I'll put up a live chart and we'll take a look at it because we've got some extra time here. So just some comments. We're talking about this applied to one market, one time frame. Using trend lines, they're so important, so important. So if you haven't used them in the past, start using them, and you'll begin to see. And it'll take you time to get to the point where you're comfortable with them, but they're very, very useful. Volume, a key thing we see over and over and over again, how important it is. We've talked about the waves. We've talked about shortening of the thrust, a couple of different ways to see shortening of the thrust. We've got springs and up thrusts. I didn't put fall through the ice in here and jump across the creek, but those 4 trades are really key trades. And I hope you see that now through this presentation of 2 very different time periods, 2 very different markets, although they both happen to be this currency. And 2 very different time frames. And you can see that the springs and the up thrusts are occurring all the time, frequently. So be patient when you're initiating trades. Wait until the market's at a key structural point. We saw this in the Aussie dollar, and we see this in the swing trades that occur here. And days will go by, and that's okay. You need to be patient. It's one of the most important lessons a trader learns is how to sit on their hands. One of the most important skills is how to sit on their hands and not have their hand on the mouse ready to press the button, either buying or selling. So wait until it's at a key structural point and let the market tip its hand at that stage. And what I'm always looking for is low volume there, so no demand or testing, depending on whether it's up or down. And I'm looking for that key reversal bar, okay, that key reversal bar to let the market tip its hand, or a spring or an up thrust, or a hidden up thrust. They're all very good. And you drop down to the lower time period or the lower time frame to make the trade. That's what LTP stands for, lower time period. That's what you want to do all the time, is make the trade on the lower time frame. Don't be looking at the lower time frame. Don't be focused on that and working to work trades off of that. Use it for your entries. Use it for your entries. Otherwise, monitor the market on the higher time frame, or the slightly higher time frame. And what I did tonight is what I did in both cases, really, both the Aussie dollar, but especially the pound here. It's a good model for your own practice. As I said before, get lots of data and just go through it and start marking up your charts. And then once you do that, get more data and go through segment by segment, bar by bar. Hide the bars from view and then walk through them, walk forward through them, and see what you can see. That's how to practice. And as I said, we do this in deep practice every Thursday nights. The cost is fairly inexpensive. It's less than $100 US for a month, and we do 4 weeks every month in this. If there's 5 weeks in the month, sometimes there is. It's like every 3 months. We take that off. We find that everybody needs that break, especially me. But it's helpful for everybody to take that off. And we usually take 1 month a year off as well. But we just had our 75th. I didn't realize it. I should have said something last night. or last Thursday, we did our 75th deep practice session. And I've got most of the people, not everyone, but many, I should say, many of the people have been in there since the beginning and have never left, which is nice for me. I mean, it kind of speaks to the value that those folks see in it, I think. So that is there for you. If you're interested, but you can do it on your own. You don't need to do it. You don't need to have me do it. Okay, let's. If there's any other questions on that, I'll be happy to address them. But let me see. Let me see a couple of things here. First of all, let me just close out of some stuff that. And pull up a chart or two and give you some more ideas on this Weiss wave here. Yeah, here we go. Now, this is going to be a bit of a problem because you're not going to be able to see it on. Okay, let me see if I can do this. The screen, the recording that I'm making is a little bit, I wasn't planning on doing this. So the recording is not, so here's the, on the S&Ps, the charts are going to, here's what I look at when I look at my trading. I've got the 27,000 tick chart, the Weiss wave is on that. I've got a 9,000 tick chart, and these numbers here are just the numbers of the volume. It's very useful when you see that, you know, you've got 456,000 contracts and then the rally up is only 130. The Weiss wave does that for you. You can put that in. And then when we come down here, it's only 230. I mean, you can certainly see it on the bar here, or on the volume, but it's helpful here too. So I look at the 9,000, and then here's the 3,000 tick chart as well. I've crunched my screen down so that I can fit it on the recording, so it you know, these spread out, and it's a much nicer look when I've got the full screen on. And the other thing I look at is we didn't talk about it, and I'm not going to talk about it tonight, but I've got the 310 oscillator that I've used for a decade or more, and it's a helpful thing. All right, let's take a look. Here's a 5-minute chart. And we'll put volume on here, okay, like this. So here's the overnight, and you can see this starts at about 1640 hours. So what is that? Oh, this is Sunday night. This is tonight. In fact, this is trading now. So you can see the overnight. Compare the volume. It doesn't even show up on the screen until I get rid of the US session. And I'll just do that here. And it will pop up. But you can see 890 contracts. What's this big bar here? 2,214 contracts. Okay. Look at this. 102,000 on a 5-minute bar. This is a 5-minute chart. Okay. Even down here, more average, 15,000 contracts. Right. 15,000. Even this small one, 8,500 contracts. And over here, it's 600. You know, that's the thing. That's what I'm talking about in terms of the overnight. It's just not there. Okay, it's just not there. And if we look on the 3,000, wow, look at this. Right, it's just these two bars here. It compresses all of this data down into a couple of bars. Why? Because this is not tradable. Right in here, so we rally up, and now we've come down. Now I'm sorry, we're looking at this here. This is okay. So that was yesterday. So this is so far what we see tonight. Let's go back to this. Let's try to figure this out here. All right, so 2 o'clock in the morning on the 9th, 13. Okay, so here we are here. Is this the 9th? Yeah. Yeah, here's you know, you can see this in here from about 16 to 1900 hours. Where is that here? Why am I not able to do this? Why do I have such confusion here? Oh, I get it. I get it. I don't look at this for so long. And see, it's so hard to see this. Anyway, this is the overnight here to about 2 o'clock in the morning. And this is the same time period here till about 2 o'clock in the morning. Okay? To me, this is hard to read. It's very, very difficult to read. This is much easier. I can see the shortening of the thrust and the negativity coming in here very easily. Here, I don't know what it's doing. I really don't know what it's doing at all. Okay? All right. Let's just add in here the Weiss wave. And I'll make this stronger for you so you can see it. Okay. These, you can see these. All right, let's go to a day. Let's just take any day here. So here, this is the 8th. This is this day here. At around 12 o'clock. Okay, so we're coming down pretty choppy down here, right? And it's probably not the best example, but we've got downside volume here very strong, upside volume lighter, and then downside volume gets lighter, saying that we're going to try to rally up in here just around 11:30. Well, look at this at about the same time. You know, it's hard to read this in here, but when you've got the wave volume in here, you know that we're going to try to make a rally in here. Not a great rally, but you know it's going to try to rally. See if I can find another example that's helpful in here. Let's go a little bit further during this day into 15, okay, about 3 o'clock. Here we are. Well, it's, you know, it's a little bit difficult to see what this volume is doing in here on the intraday. That's the point. It's kind of hard to see how to read this volume in this section here. But in here we can see that there's just not much upside volume in the waves. Okay? And we know that the downside here was much stronger. Here it's very hard to read this volume in here. And that's the same. I can show you that it's the same. If I do this, you can see that it's the same wave down. Look at the volume down in here. Very difficult to read this volume. It's a little bit easier to read the upside volume because it's not coming in, right? But with the wave, it's a much, and look at this up wave here. Up wave is on strong volume. Look at what it does on the intraday volume here. Very difficult to read this. And we know that there was good upside volume, so it's going to chop around in here a little bit, which is what it does before it finally comes down. Anyway, it's a quick look at how to see the differences between the two. The question there then is, there's another question: are the wave lines you're drawing different than Elliott waves? Yes, absolutely different than Elliott waves. Elliott looked at the structure of the market through waves, but in a different way. He counted his waves, 5 waves up as an impulse or motive type waves, and 3 waves down, the basic Elliott wave pattern. That's very different than what we're doing here. Let me take this offline. Elliott wave, would say there'd be 1, 2, 3, 4, 5 up, 1, 2, 3 down, and then we can expect some kind of 5-wave pattern up again. And so he would count these and look at the waves, try to understand the market through this sort of a wave structure. And it's very different than this. This is looking at supply and demand by market movement. That's all it's doing. It's not trying to count that there's 5 waves up and therefore we should have a big reaction or anything like that. Or try to figure out the third wave of a third wave up. None of that is the same here. So they're very different. What's the oscillator indicator? I said it's a 310. How long is deep practice? And are members trading with you, or is deep practice looking back at trades? Deep practice is not operating during market hours. I do not like to trade live and try to teach at the same time. I need, for me to trade well, I need to focus my mind on the trading and not be doing multiple things at the same time. I'm not a good multitasker, and when I've done that trading, it's, I do it from time to time for my friends over at the Trade Guider group and, that sort of thing. I'll do it once, and if I'm working with somebody one-on-one, I might do it with them too. Although even then, I don't like to do it because 2 things happen. First of all, I'm not trading well because I can't do 2 things at the same time. And the second thing is the person doesn't learn. They rely on me calling trades and stuff, and it's just not a good thing. So deep practice is going through bar by bar like this. We might look at a market and start going through bar by bar. But what we would do is we would look at the daily and maybe the hourly chart ahead of this and try to figure out where are the key points and what are we going to do around them, and try to create a game plan. And then we'll go and look at those bar by bar and talk about what we want to do here, if anything. And so that's deep practice, more along those lines. So Yusuf, or Abdullah, you had a question about this. The waves, an up wave starts. This is, here, let me go through this so that you can see this properly. So the wave on the inputs, this is the DW wave chart, David Weiss's wave chart. You can see here the retrace is set at 3/4 of a point. Okay, you can change it to 10 points, you can change it to a half a point, whatever you like, you can put it in here. All right, and they're coming off of the closes. You can put this on the high or the low. You can make a formula. You can make it an average if you want in here, and you can change the colors. And you can do a few other things. I won't talk about those. And the same thing with the wave volume. You've got to plot both. And here's the retrace is based on 3/4 of a point. And you can change the colors and the high and low price of the wave. So what this does is we're coming down, and every one of these bars, if it does rally up, like here, it's not going more than 3/4 of a point up on a close basis. Okay, so it comes down to this low or to this close, and certainly by this bar here, it's probably hard to see because I've got this now drawn very thick. So I'll thin it up a little bit. By the time it gets to this bar here, there's more than 3/4 of a point. Let's just show you what I mean. If we look at the close here, the close is 1378 1/4. So what we're looking, I'm sorry, the close here is 1378. So what we're looking for is 1378 3/4 or greater on a close. Okay? So the next bar, 1378 1/4, is not 3/4, but this bar closes at 1379 1/4. That's definitely more than 3/4 of a point off of this low here. And so the wave would change at this point. Okay? So that completes this down wave and begins this next up wave. This up wave doesn't change until we get a close 3/4 of a point lower. Okay? All the while, it's drawing the line, and so you can see if the wave is bigger or smaller than the previous waves, and all the while it's accumulating the volume. I don't know if we've got it. I took it offline, but you can see that here we're just forming this line here, and there's no volume really even coming in. It's not showing yet. I'll put it online, see if it has any volume. It may take a moment. Yeah, there's not really. Okay, so it moved a little bit, but there's no real volume coming in. Okay, and it just changed from an up wave to a down wave because the it didn't have the well, okay, there we are. It didn't have it. It hadn't closed yet. This bar hasn't closed. Until the bar closes, this wave can go up or down. It can move back and forth. Okay, Abdul says, what I've been struggling with is how to trade using the Weiss wave. I think I understand that you are looking for change of behavior, but sometimes I have a hard time to find that. Yeah, you got to look for it. You've got to be able to see that. Look here on this chart, just looking at this, I got to change the behavior here. At this, well, this is now live, so I got to take it offline to be able to draw and hold this. So this is a change in behavior. This wave down has gotten bigger here. So now I'm looking for an opportunity to go short, and here we are. On this push up, I have light upside volume. Now, we haven't talked about making a trade like this, but this would be something that I'd be looking for. Okay? That kind of a thing, because there's a change of behavior. I'd be drawing trend lines on this chart. I've got an up wave here that's just been grinding up. And I could draw my trend lines in. I mean, this is the basics for using. And I can see I'm not getting all the way up here. I'm getting some shortening of the thrust. Big effort to rally up. I do get an up wave, but then suddenly I break the trend line. Big down wave. Now I'm looking for an opportunity to short. Okay. Am I calculating risk-reward ratio before the trade, or just go in when the proper trade setup occurs? Good question, Murat. On the intraday, for example, if I'm looking at a trade like this, then I know that certainly it would be great if I could get a trade to go all the way down here. But I might cut this in half and say the halfway point between this low and this is a typical point for where the market will often stop. So I might look and say, okay, do I have much of a trade here? Well, if I got in, say, at 83, about here, and I was able to trade it down to 76, give or take, 77, and that's a 6-point trade in the S&Ps. That's not bad. I'll take that trade, sure. and I might have a 3-point stop on here. So a quick calculation, I've got a 2-to-1 risk reward. If I'm risking $1, I'm apt to make $2 on that risk. That's not bad on an intraday trade, so I'll take that. I'm not, I think in those terms about where am I. If I have, let's say that this, for example, was an up thrust here. It's not, but let's say it is, and I was interested in taking this trade, then and I see that this is the low here at 76, and I'm at 84. So there we go again. I could take that trade. I would. That's how I typically do it. I'm looking for where's the logical point to exit this trade. It's going to be at support or resistance or something like a halfway point. Those are the basic ways that I do it. And no, I don't use Fibonacci. What data feed am I using? I'm using TradeStation. I've been using it since 1999. I've used lots of other things, but this is a good, solid, professional level trading platform that I can do an awful lot with, and I like it. So, Brian says, sometimes I get caught out by the following. There's an uptrend in place with maybe 2 good up waves. Then a large selling wave comes in, not as big as the volume on the up waves, but decent. The angle, however, is shallow, so I would view this in 2 ways. Potential bearish change of behavior or no result from effort from the sellers, therefore just short-term profit taking. Any views on this? Yeah, I would say it's probably, if it hasn't broken a trend line or it hasn't clearly gotten larger than the previous down waves, then the odds are good that it's just profit taking, and especially if it's got big volume and just going sideways. Let's see if we can see an example here. Well, here's an example in the opposite direction. Here's 2 examples here where we're grinding down, and then I get a wave up, which is not bigger than the last down wave, and a little bit, it's bigger than the up waves in the past, but it's on good volume, but it still wouldn't be something that I would then look over here, let's go long. I wouldn't be doing that, okay, because we're in this big downtrend, and if I drew a trend line in here, I haven't broken anything. I haven't broken the trend channel. Same thing here. We come to this point here, and I'd extend that trend line. We're not really breaking it, so I'm not looking to go long here, There's nothing here that tells me to do that. Really nothing at all. So this requires practice. There's no question about it. I wouldn't be interested in anything in here going long until we've broken this level here. Here's where I'm interested in going long. And it's way, way up in the trend line, right? There's nothing here that really interests me. And I'm really looking to go short because we've been in such a good downtrend. Okay, any other questions on that before we slip off into, we're just going to keep going here and do this Aussie trade and show you that. And this will kind of explain a little bit. I'm getting questions about, risk reward and that sort of stuff. So maybe some of this will help out. This was a trade that I did. We had just come in from Malaysia. We were in Kuala Lumpur, and we flew in all night, and now I'm in a totally different time zone than I was in, and still hadn't adjusted really well from my native time zone. So I'm up half the night and sleeping half the day, or trying not to sleep half the day, trying to get into a better rhythm. And we were up one night talking, and a trade set up on the Aussie dollar. And we took it, and it was a good trade. So what I wanted to do, which is what I did in Australia, is just walk you through an actual trade that I made. I'll show you how I assessed the structure, how I identified a potential trade, where I took it, a mistake that was made when I took the trade, an error that was made, but not a great one, not a terrific one. was sort of an unknown error, not really an unforced error. There was a better location to take to buy this trade, but it, you know, I didn't know it at the time. We'll talk about good money management in here and how I manage the trade as well. And then you'll see in this that there was a lot of noise in the background and how we focused on the process of the trade and not what the results were. Okay, I'll explain that as we go along, you'll see. So when I looked at the Aussie dollar, here's just a bigger term view of the structure. And I can see here that this thing is in a huge trading range from whatever this level is to whatever this level is. So $1.05, I think, or $1.10 down to 89, give or take, right? And I notice that we've been up against this 3 or 4 times now. So longer term, the odds are good that this is going to come down a little bit. I don't know where it's going to go. I mean, maybe down to this level. I mean, the way I would frame this out if I were thinking about it is I would think, okay, maybe it's going to come down to this point here if I took a trade up in here, okay? Down for a short. If I'm thinking longer term, that would be the play, to try to get 6 or 7 cents out of this move down here from this point up here, which is around 110, down to this point here, which is about 1.0, or maybe a little bit bigger than that. So maybe I'm looking for a 5-cent move, which would be a pretty good move in the Aussie dollar on a swing basis, okay? But I wasn't trading this on the swing. I'm looking at this on the intraday. And what we were looking for was a couple of day trade. Or looking for a day trade to begin with, and I thought if it worked well, then I would try to hold it for a couple of days and see if we couldn't get it back up to retest around this level here. So I was looking for maybe a 2.5, 3 cent. We were down here at 103. And maybe a move up to 105. So I was looking for two cent move here. Would have been a nice move in the Aussie dollar. So what I was looking, but I wasn't expecting it to go up any higher than that. That was the main, the play that I would go for if we could get it, see if it could go back up and test here. Okay. So what I noticed was that, why was I even thinking of going long when this thing was bumping along the top up here? Well, the reason I was thinking going long was because on the move down here, I'm noticing that this is kind of choppy, grinding move down, what I call a grinding move down, but really no ease of movement, no big solid vertical or big solid widespread bars going down on this. We had one here where notice that we upthrusted in here, right? A little upthrust on the daily here, and that had a good move down. And we came down here and for some reason stopped. And look at the move up. 1, 2, test bar in here where it comes down and tests on very low volume. Drive up. Tests underneath here, drives up. So I've got a situation in this market where in the immediate background, in the immediate structure, I have good ease of movement up as evidenced by these price bars in here. Okay? We get to the top and notice a lot of volume comes in. We get to that 105 level and some good volume comes in, and it's bigger volume than anything we've seen. That's supply. There's a change in behavior, right? And we come down and notice at this point we hold here at this 10290 level. We had that level here, and then we held here. Okay? So immediate background, ease of movement up, and suddenly we're finding support at this 10290 level. So I'm curious about this. And I want to look at the intraday. So I look at my wave chart. This is a 5,000 tick bar chart. A little bit higher time frame than what we were using earlier, because now I'm looking at structure. Longer term structure. So what do I see? I see big waves going up, and then as we're coming into this trading range, do I see any big volume coming in? I don't really, do I? I see some volume here and here and here, but it's not bigger than the up wave volume. So this is looking more like a correction to me than anything else. I notice on this move up, volume to the upside comes in and the wave comes up. The wave builds up here. And I also notice this, that on this down wave, I've got biggest volume in this move down. But what happens? I don't even break below the low here. I don't even make a new low on all this volume. What does that mean? That means that buying was holding this market up. It looked like selling, but somebody was buying in here and holding this market and not allowing it to go down. Okay? Everybody see that? Yeah, no result for the effort. No result for the effort. Okay, everybody see that? It's very subtle. This is a more advanced understanding, if you will, of the Weiss wave. But there's a lot of effort to go down here and no result for that. By the way, these little dots here, these red and green dots, they're the VSA signals that are on TradeStation. I'm not going to go into those tonight. They are certainly useful. Certainly useful for learning this method. The Trade Gutter software is very good for that. So we come down and we finally do break down below the lows. And this is roughly where we are, right in here somewhere. When we were looking at this chart, Fiona and I were looking at this. We were at her partner's place there, Greg's place, and we were up late, and so we were looking for a possible trade, and I saw this, and look at the light volume. And we didn't get a pickup in volume here as we broke. We didn't increase over this volume. And on the last wave down, on this higher time frame, we get hardly any volume coming out at all. So I'm looking at this and saying, boy, an aggressive spring is a possibility here, because this is that 10290 level here and here and where we are here now. And I noticed that buying count, good buying came in off of that here. And I also know that good buying came in off of that here, because even though we don't get the volume, certainly the spreads just popped right up here. So I knew that this was an important level. Okay, looking at the structure. And all of this is going, I haven't taken the trade yet. This is all my preparation for looking at a trade. Okay. So I'm looking to make a spring trade. And we started looking at this. Now this is New York time, that's down here. But roughly when I took this trade, it was about 4:30 in the morning Australian time. So whatever, that's at that green arrow, that bar at that green arrow. That's when I took the trade. So whatever time we were looking at this, I think we might have started looking at this around C here. We watched this all night long looking for a trade. So let's talk a little bit about this. As we come down and break, this is the dotted line, is that 10290 level that we knew is good support, where the market popped off of it a couple of times. So now I'm down on a 1500 tick bar chart. Okay. And we might have used a 500 to initiate this trade. I don't even remember now. We probably did, but I don't know if I show that or not in here, but in any event, we were also trading off of this for the most part. And this became my intraday structural chart. So I can see I've got a good sized down wave here, and suddenly the down wave shortens. As we break down below this key level of 10290, the down wave shortens. Well, I'm interested now as a potential spring of this. Also notice that the volume has gotten slightly lighter, but it's about the same amount here, and the wave is smaller. So that's telling me that somebody's buying in here. Remember that effort versus result idea? There's effort here in the volume, but the result is not a big wave down. So I've got some shortening of the thrust coming in on this B wave. Okay, so now I'm looking for a change of behavior. I was hoping I'd get it here so I could have gone to bed, but it didn't happen. We push up, and what happens? We get supply, we get an inability to rally above there, and no volume comes in to the downside, right? And so what happens? We come down to see less volume still. And I don't see an increase in the downside wave. What I see here is it's getting smaller. Again, slightly smaller than B, the wave down to B. But I still don't have a change in behavior. I still don't have, there is a spring here, but it's not good enough for me to take a trade here. We saw it, we looked at it, we talked about it, but it wasn't, I didn't see this. I didn't know if this market was going to kind of roll over and just kind of drift down at this point. We had tried twice now to get above this level, and it didn't happen. And I had no real reason to go long here. We had, some of the VSA signals. We have a test. All this is either no supplies or tests, which is positive, but still no reason to take a trade. We rally up here, and again on no volume. We come down on this D wave. Kind of interesting because it's at the same level as the spring with no volume there. But still, I don't have a real reason to take a trade at this point. We rally up, and then we come down to E. Now, this is interesting to me. Now I've got a reason. Why? Because not only do I have shortening of the down waves, but now I've got an effort to push this market down with no result. There was an effort to push this market down, but there was no result on shortening of the thrust and shortening of the down waves. There's enough evidence that buying is going on that I elected to take the trade as we pushed back up above, just before we pushed back. I think I took it as we broke here along this high because I figured we were going to break up. And I was also at 4:30 in the morning, even though I was jet lagged to a fare thee well, I was exhausted at this point and I really wanted to go to bed. I also knew that by this point, volume's coming in on the up wave. I could see this. So I was happy to get aggressive on this. And I put 5 contracts on this, which was okay for me to do on my account. It was actually a fairly small, not small, but not big either in terms of size. But it was respectable. It was a reasonable. Yeah, there's also a second higher low in here as well. Okay, so let me erase some of this. So I'm long now on this bar, and I go to sleep. Now, before I went to bed, I put a stop in. I didn't want to put it here because it's possible that this market could still go down. And I didn't want to put it all the way down here because I knew with 5 contracts that would be a little bit more than what I wanted to put as a stop. But right underneath here was good. And I figured that if it got down to this level from here, it was going to go down to here anyway. And I often do that. If there's a situation like this, I will often put it, I try to give it enough room, but I'm also, not going to put it all the way back down here so that if it goes down here, I take a big loss. So this was, if I remember correctly, this was about $1,300 stop for me. Approximately 1,300. Maybe it was 14 or maybe it was 1250. I forget exactly, but it was around this number. Okay? And typically, I don't like to put more than 1.5% and certainly no more than 2% at risk in a given trade. Okay? And this was about 1%. So you can figure what my account size is from that if you want to. But it's certainly, this was a doable trade for me. Not a big deal. Okay? So there was my money management. And I'm thinking that I could get, a good 2-cent move out of this market. And on 5 contracts, that was about $10,000. So I had, or $8,000, I think it was. So I had a good, better than 1 to 4 relationship on my risk reward. So good money management practice in here, good risk to reward on this. If it went all the way up, that was what I was playing for. Okay? All right. Everybody understand that so far? Any questions about where we are on this at this point? Okay, good. All right. So now I said that there was a better spot to take a trade, and there definitely was, and that was at G here. Because at G, now I've got a change in behavior at F, because now I've got more volume coming in. We did break up. If I was looking at this, I wouldn't be really happy that we didn't push through, but I could live with it. I see this a lot. Trading around yesterday's high or low, or this was a multi-day low. Sometimes trying to get through it is a little bit difficult. But on the pullback to G on very light volume, and then we get these nice key reversal bars in here and in here. You could have easily taken a trade in here. But I didn't. I took it a little bit earlier than that, partly because I was exhausted and I wanted to get to bed. I wanted to get a trade on in this market because I saw a good opportunity here for a good move. And I just did it probably a little prematurely. It wouldn't have amounted to much difference, but if looking at this in hindsight, the best trade was in here at G. Okay? And so we don't always get, and I probably could have put my stop up a little bit closer than underneath here, but that didn't really matter either too much. So now, the market, when we got up the next day, the market, I think we were in here somewhere. And we were getting close to the close of the day, so it had rallied up. So what did I do? I moved my stop right up underneath this low here. Because I figured that here was yesterday's high in here. We had broken above that. It's unlikely it's going to come back down, but it might do kind of like what it does in here. So it might come down into this level in here. But I figured that this was enough of a shelf of a support, and on a small time frame, this was a jump across the creek and then a back up to the edge of the creek right in here. And so therefore, it shouldn't come back to there. So I put my stop in here, and I think we had probably about plus 600 or so on the stop. If I had gotten stopped out, I would have about $600 in the bank. So that was good. Okay. I need to go forward here. I forget what this looked like. Let me just go forward a couple. Yeah, okay, good. So that's where I put the stop. And at this point, and we'll come back to this in a minute, but at this point, people were saying, well, you've got a lot. This was about $3,000 I had in the trade now. And I was being asked, why not take it off? Okay? We'll talk about that in a minute. All right, let's look at this now from a conventional perspective. This is a 60-minute chart. And you can see here's the Asian session. It's a little bit difficult to read. That's where we were in the Asian session, right in here, which is why it was a little bit harder why we were being so patient waiting. But when I looked at the 60-minute chart, and it's often useful to do this, we're coming down, and we know that we were coming down, and this is where we started to get the down waves getting smaller. Well, when we look on the conventional bar chart, we see volume start to pick up here, and it holds. And we dip down lower, and it holds. Dip down lower again, more volume, and it holds. Dip down even lower, and look at how this is holding nicely on all of these bars. They're closing firm. They're showing that buying is stepping in. And we push up, and they weren't satisfied. They wanted more contracts. They dipped underneath. This was, I think, that spring at sea. More buying coming in. Now look at this bar. It's a down bar on the biggest volume on the day, and then it turns right around the next bar and goes up and closes firm. That's accumulation if I've ever seen it. Okay, that's a very good example of accumulation. And what they were doing was kind of sneaky. They were accumulating underneath that important low, okay, for a small move up. But they were doing it. So that's just a conventional look. Now, as I said, as we went along here, this is where we were at this point, and this is my dome here, and you can see I got 5 contracts on. We've got an open profit here of 3,200, and you can see that I put my stop in here, and that was, I said, about 600, or I think it was maybe 640 or something like that. I had that in the bank, and now I'm being said, now I'm Greg and well, actually at this point, even before this, I think by the time we were ready to go to bed, I had 200 or 300 in the bank here. And one of the people watching this said, well, why don't you just take $200 and call it a day? That's a good trade. And I said, well, no, because that's not my process. I'm in a trade for a reason. And the reason I explained to you on all of the detail of assessing and analyzing this market and looking at the structure and looking at that 102.90 level and looking at the waves and looking at the effort to go down with no result, and now we're starting to see some result come in, I don't want to take the trade off here. That would be crazy. I'd put risk of $1,000 on here. Why would I want to take it off at 200? Okay, so I didn't do it there. We went to bed, and the market rallied up, and now for the second, now we're up 3,200, and now another person comes in and says, well, why don't you take 3,200? That's a really nice trade. And I said, no, there's more to go with this. Why would I want to do that? Why would I want to do that? We've just broken above yesterday's high, and we've broken above that 102.90 level. This is big. This is important. We want to stay with this trade as long as we can. This is my process. And yet, I'm trading in front of other people, and there's a piece of me, there's a part of my mind that's saying, yeah, Gary, take it off. You'd be a nice hero doing that. You'd make $3,000. And that's pretty cool trade, and you could go out and have a nice dinner, right? But and I heard that, believe me, I heard that, and no question, I heard that, and my mind was telling me to do that. That was the easy way out of this. But that's the noise, that's the psychological noise going on in the background, and I had to remind myself, because I got, doing this. When you're doing this in front of other people, it's one thing if you're sitting and you make a mistake and you say, okay, fine, I made a mistake. It's not a big deal. I'll learn from it. But when you're doing it in front of other people, the ego kicks in, and everybody's got an ego, myself included. We're all human beings. And it becomes very difficult. And I did want to take the trade off at $3,200 and have a nice profit and say, oh, that's cool. But I also know that if I listen to my mind and what my mind tells me in the heat of the moment, that it's not a good idea, that I will come to regret it afterwards. And my mantra is, always, when I'm trading, to have a process and to follow a process. And that's what I did here. I overrode my psychological thoughts. And in a way, it's everybody from the outside is telling me that. But I heard it too. Mentally, I heard that too. And they were just reinforcing it. Take the trade off and go ahead, walk away and be a hero, right? I felt that. I felt that pressure. There was no question about it that I didn't feel that pressure. But there's that kind of thought, and then there's the right thing to do. And the right thing to do was to hold this trade because there's no reason to take it off here. My process is to hold the trade until there's a reason, or there's a target that's hit. And there's no reason and there's no target that's been hit here. The interjectors were just evil nobodies of trading. Well, they were just people, acting as normal people act. And, that's that. And that's what was happening in my mind, too. So, when we looked at this, is actually a little bit earlier. I had targets here. Maybe I got these slides out of order, but the initial target is here. Maybe it comes to this trend line and dies. So I want to at least get to this point, right? And then I've got another target here, higher up, and another target here. And the initial target, if we get up here, is up to here. So I don't want to take it off at $200 or even $3,000, okay? I want to take it off when I'm being told by the market that it's a good time to take off. So look at what happened. We held that trade, and now we're back to now we're on a 5,000 tick chart, a little bit bigger time frame, and I'm not seeing a tremendous amount of volume coming in, but I don't have any reason yet to get out. We hit the first target, and we hit the second target. Okay? Climbing the wall of worry. That's right. We're climbing the wall of worry. And I've got a nice uptrend going on. I've got higher highs, higher high here over this last little swing high, higher low, higher high, and so far I'm just holding gains, and I've got a trend line in here as well. Okay? Now, we didn't get all the way up to the top of the trend line here, but that's because we were at resistance. So I'm anticipating we're at the end of the day here, and I'm anticipating that we're just going to kind of go sideways and then maybe go up and try for this level. That was my next target. Okay? And if we look at the end of the first day on a daily basis, I got a pretty good move out of that. I'm happy. We bought it probably just as it was closing down here and going into the next day. So I've got a nice trade on. Okay? There's no reason to take this off. And so just once again, here's the targets. So now we're into the next day now, or this is at the end of the day. So what did I do? In the process here, I moved my stop. If you remember, the stop was down here initially when we were up in here somewhere. Once we got to this point and we sprung off, once we got to this point here, we broke up above this, I moved my stop up to this level. And now I think I had locked in about $2,500, something like that. And then we had a spring here, and this was an okay place to add to the trade if I wanted to, but I didn't do that. You could have added in here as well on this pullback. And there was a small spring here, little VSA signal as well, a testing type bar. But you had a small spring in here, a nice, and this was the test of the overall spring, right? So this was a good spot to take a trade. This was a good spot to take a trade, but I already had 5 contracts on. That was good enough. I was happy with that. And trying to trade with other people talking to you and talking at you, and other people wanting to go out and let's go to dinner, and I've got a trade on it. I don't want to add on, and build this up to a 20 contract project. I'm happy. I was just happy holding that 5 contracts on there and just going with that. But there were other opportunities to either go long or to add to this, okay? And I'm still seeing pretty good movement up here. One thing as we come into the end of this day that I'm not too happy about, or I shouldn't say I'm not happy about, but I'm concerned about, is the increase in volume on B, okay? I can see the wave A here, we got good movement up on that kind of volume. On B, I have a slightly smaller wave up, and I've got quite a bit more volume, maybe a third more volume. Somebody's taking profits in here, but that's typical. This is the high, that first target high that we made that day, so that's not unsurprising. So I just moved the stop up to this level here, and I think by this point we probably had I think it was $3,400 worth of profit in here, something like that. 32 maybe, something like that. I don't know. 3,000, so somewhere around there. And by the time we closed on that day, and again the noise was going, whoa, boy, you got $4,700 in the trade. Why don't you close it out? It's the end of the day. But I'm looking at the daily chart and I'm saying, no way do I want to do that. Though I noticed the effort to go up on B and somebody's stepping in and selling off. But I'm assuming that that's okay because we're at resistance and that's kind of normal. Okay, however, we go now back down to we're back on the 1500 tick chart, which we were on before. Here's what happened. And I get out of this trade. Here's what happened. This is where we ended the chart on the last one. We were at the close of the day. And there's that wave B with a little effort result. And I noticed that on this pullback that I got more volume coming in here than I had all day long. Okay, so now I have some potential supply here and some potential supply here. It's not quite a change of behavior, but I'm noticing this. It's subtle, but I'm noticing it. So as we rally up, I move my stop up. So I've got $4,000 in the trade, give or take, at this point if I'm stopped out. So you see how the money management works? I move my stops up as we're going, and as I am seeing danger come into the market in terms of the effort versus result and a little bit of supply on this last wave, then I start to move my stops up tighter and quicker, right? Because as danger comes in, then I don't want to give up what I've got. Instead of keeping the stop down here, which would have been a normal thing to do, figuring that, it could come back down and test this overnight. I don't want to do that. I don't want to, because it could come down and then I could come all the way down. I don't want to give this up, so I bring my stop up. All right, so what happens? The next day, we're up around 10 o'clock in the morning, and what do I see? I see wave C go up here, and it's substantially smaller than any of the other waves up. And I see very light volume, no demand. What happened to the buyers? So I exited somewhere around here. I forget exactly what bar it was, but I said, that's it for me. As this started to come down, I think we definitely made a new, I probably closed it out right on the close of this bar, or maybe just under the close of that bar. I got out of that trade because of this. And it was nice because it didn't hold. I could have waited and just moved the stop up to this line here, But I didn't. I saw this and I said, time to exit this. This is enough of a warning now. I've got three things going on in here. And you can see the shortening of the thrust occurring. We have this move up to here, and then to B, right? A, B, and then C, right here. So I knew that, okay? And I didn't want to overstay the welcome. So we got $5,850 in here minus the $30 or so for the but this is the Aussie trade here. This is my statement. I took out my address and account number. You don't need to see that, but you can see that we bought I don't know why it says 8 and 3. That's unusual. Did I go overboard with that and buy and sell? I forget. But anyway, it was 5 contracts on the Aussie dollar, and that was the amount that was credited to the account. So that was the trade. Just for disclosure, I didn't send that out to you. You guys don't need that, but just for disclosure, to show you that it was an actual trade. It really was. And so here's just some comments about this. And a way that you might use this, in part anyway, to model your own trading. The higher time frame sets the structure. You saw that I went from a daily chart, and then I used a 5,000 tick chart, and then a 1,500 tick chart, right? So I'm letting the higher time frame tell me how to trade, all right? Money and trade management were key considerations in this. I didn't put a trade on that I couldn't afford. I didn't, build up the contracts all the way up on a trade that I couldn't manage well, because I'm in an, I've got to also be with other people when I'm here. And so I didn't want to build this up to a huge project. So I had my money management in place, and I had my trade management in place, always moving the stops when I could to protect the profit. The Weiss wave, I just basically traded off of the Weiss wave, and using classic trend lines, and using obvious support and resistance, not just to set my trade initiation and my stops, but also as targets as well, basic targets. When I trade, I'm looking for things that everybody else, every other trader can see. People like to use Fibonacci and floor trader pivots and other kinds of stuff. And I'm sure they work some of the time, but for me, I like the obvious stuff. I like the obvious stuff. I know that everybody sees it, and I know that it's going to be important when we get there. And it's all Wyckoff principles, nothing that we haven't talked about over these 2 sessions, last Tuesday and tonight. They're all the basic principles that you can review that. We do have VSA signals in there. I didn't emphasize them tonight. We were doing a lot of the folks in Australia use the Trade Guider software, and it's an excellent piece of software that's really, really good for learning this stuff. And also the dialog boxes are excellent. Philip Friston, who's a great trader and a really nice guy, rewrote all of them, and they're really spot on now, as they would say. They're really excellent, and you can also use them to trade with. But it's an exceptionally good educational tool. And it's also about the focus on the process of trading. What's your process? Well, my process is to follow the Weiss wave, to use the trend lines, to use basic Wyckoff principles. And if I get nicked and I get taken out of the market and I don't get all of the ticks or all of the pips or all of the points, so what? I'll do better next time, And I'm pretty blunt about what I did wrong on this. I didn't get in at the absolute right spot, but that's okay. Sometimes we're not 100%, and I wasn't that night. And I was just really looking to get the trade on and not really kind of think about where the absolute best spot was. I was very focused on where to get out, and that, I wanted to make sure that I was good at doing that, and I thought I was really good, because actually the market fell after that the next couple of days. I think it went sideways that day, and then the next day it fell. But you can see how there was a lot of noise and a lot of pressure to take profits. But what I wanted to do was not succumb to that pressure, because I know that if I follow my process and I am consistent and true to my process of trading, then over a large number of trades it's going to work out, and I'm going to be a much happier trader and a much more profitable trader than if I listen to my mind or the minds of other people reinforcing what's going on in my mind and trying to get me to do something that's outside of my process. And then I know I've made a forced error or an unforced error, and I try to minimize unforced errors. Okay, questions here. For the huge volume up wave B, well, it wasn't that huge, was it? Let's go back. The huge volume up wave B. Yeah, there's good volume there, I'm sorry. Was the wave shortened for bigger supply coming in? Yes, Marcus, exactly. How are you? Nice to see you in here. I didn't see you before. If you look at this and to here, and you look at A to here, you can see that there is a difference. And if we measure that from the low here, which is right here, if we go up here to the high, we can see that we made all this progress on wave A, right, from this low to this point, and on wave B we only made this progress, about half of that. So when I look at this volume and that kind of progress, and I look at about a third or maybe 20% more volume on B and about half of the progress, I'm not too excited about that. That tells me that somebody is selling into this. There's certainly buying, and it's still up, but somebody is selling into it. Okay. Terry says, another great session, thank you, and big thanks to WeissWave too. Oh, good, great. Yeah, it's great to combine the WeissWave with the Wyckoff stuff. Great, thank you, Terry, appreciate that. Antong, thank you. What happened after C? Did the market continue? No, what happened after C was, if I remember, Fiona, you probably remember better than me, I think for either the rest of the morning or the rest of the day, it went pretty much sideways. I don't think it ever made a new high. And then it started to drift, and it came down, and I think it went down through the low of this, in fact, if I remember correctly. The up wave just before wave B was relatively low. Did you not consider an exit there because you haven't seen significant selling yet? The up wave just before B. Do you mean this wave here, Brian? That wave? Let me see. Let me get a response. Yes. Okay, good. Good question. No, I wouldn't consider that wave. Let me erase all of this so we're clear. We're talking about this wave here. Well, we're still in a trading range here, right? We're in this trading range. We haven't left this yet. So I wouldn't think about this as an up wave per se, unless we up thrusted. If we came up here and up thrusted this and then started making moves down, then that would be something different. But this is not real. This is within the trading range. I'm looking for, this is something out of Elliott wave that's kind of gets at what I'm talking about. He talked about these as motive waves or impulse waves or impulse. And another way to think about them is momentum. I'll just say Momo here, momentum waves, okay? And when we're in a trading range, these are called corrective waves. That's an Elliott term. And it's good enough. I think it's useful. It's a useful concept. So when we're in in a correction, when we're in a trading range, we're not really measuring these waves per se. You can see that they're basically about the same, right? And this is a little bit bigger than this, but basically about the same size and wave. We would expect them to be, what we're mostly interested in is in the motive or impulse or momentum waves. And we can see that good momentum was here on A, B, still good momentum, the volume was a concern, and C, momentum died. Okay, momentum died. But I really wouldn't be thinking too much about the trading range waves. I'm waiting until see what happens once we're out of the trading range. All right, last call here. Any other questions? Because we are essentially done. Yeah, we are done here. So I want to thank everybody again for taking the time and making the investment into coming into this. Somebody did ask if we would give a discount on some of the other things to this group, and we will do that. Helen will send you an email out exclusive to this group if you would like. I'm just showing you the things that I do. I don't have software that I promote or anything like that, although we are developing some software for this kind of stuff, and we think it'll be pretty good. So eventually I'll do that a little bit. But what I don't really try to promote all that much stuff. You're more than welcome. You get a flavor if you haven't, been with me before in one of these training sessions. You get a flavor for how I approach the markets and how I teach. And so we have some things on the website that Helen will send you around a discount coupon for, if you would like, to avail yourselves of those. If you don't, that's okay too. It's okay. I'm a trader and I'm a psychologist, and I like both, and I do both. And I also like, because trading is such a lonely kind of business, I like doing these things and also, truthfully, it improves my ability in trading to teach this stuff. There's always the people will sort of sarcastically or not so much sarcastically, cynically say that, those who do and those who can't teach. And I think that's totally wrong. I used to think that was true until I got into graduate school, and some of the best professors that I had were brilliant psychologists. Oh my God, they were great. And I trained under some pretty impressive people who, not only taught this stuff, but wrote books. And when I had supervision with them, my God, it was just wonderful. I was so fortunate to do that. And it made me realize, and I remember asking some of these professors, people who are, just tops in their field, how come you teach? Why don't you just do the work, And they all told me, they said, well, Gary, we got better by teaching. It's not anything less than that. We teach because we love this stuff and we want to convey it to you, yes, but we also get better at it. And that kind of opened my eyes up about teaching, and that's why I really do it, is because I do get better at it, and I do love it, and I do enjoy the interaction with people. All right, so that's about as far as I want to go on all of this. Brian says, one thing I find interesting to do is to mark the top and volume of very high volume waves. They work very well as support and resistance zones. Absolutely, Brian, they do. They will do that. We need people like you to teach us, Fiona says. Yeah. Well, you got a chance, Fiona, to spend time with me on that. You got a good insight on that. David said, great seminar. It's coming together for me now. 1 a.m. in England, so time to go to bed. Yes, that's right. Time to go to bed. All right, everybody. Thank you so much for this. I really appreciate it. And I hope to see you around in the practice if you're interested in that, or in some webinar or seminar rather that we do face-to-face. It was such a joy to meet people face-to-face in Australia and Singapore and KL. It's just a real trip for me to do that. So thanks again, everybody, for coming in, and great trading. Be mindful in your trading. Stick with your process. If you don't have it, get one, and have a great time trading. I'll see you again soon, I'm sure. Take care now. Bye-bye.